we are going to be the first coin born in Japan going international.
We've been working so diligently to make this project the most groundbreaking project.
Rio will be at the forefront of this revolution.
Rio is a digital payment solution
used by the masses.
Welcome everyone to our 6th Global Live Summit that the Blockchain Legal Institute is hosting. We are so excited to have everyone here today. Matt, how are you doing today?
I'm great. We're in DC. There's a lot going on in the world today, especially in the world of Tradfi, DeFi, and how it's going to affect consumers. So that's what we're going to talk about today. It's exciting.
For sure. And today we are extremely grateful for our strategic partner, Rio Digital. And for those that are joining us as panelists and moderators, we have an international collection of visionaries who are going to be speaking on a variety of topics today. So we are extremely excited to bring everyone to the stage. And the first individuals that we're going to be bringing to the stage will actually be right after our keynote. Our keynote actually is very special because of the fact that when you're looking at traditional finance and then definance, and then now we have, it's like a Venn diagram, the blend of both. So we are going to be speaking with Patrick, who actually has created a digital asset bank. And, again, these are words that you would not have heard maybe 10 years ago. So we're going to hop over to our keynote. And then after that, we're going to have Lani Dizon and Anthony Diaz from the Rio project hop on. And we're going to talk to them about the vision that they've been working on for the past a number of years. So let's watch the keynote.
All right.
Background on myself. My name is Patrick Gerhardt. I'm president of Telecoin Digital Asset Bank here in Norfolk, Nebraska. Before I got in with Telecoin, I was a traditional banker. I was president of a bank here in Northeast Nebraska for many years. And right around 2021, I had dabbled in crypto a little bit, not a whole lot. The biggest thing with crypto, what got me interested was honestly my first understanding of what the blockchain was and how it was utilized. Not just within the finance industry, but just in general. Other industries have used blockchain for a great many years for keeping track of goods and services within their company and system. Once I realized that it's really just this great online, transparent, immovable general ledger that you can utilize for many different functions, specifically within finance, and that kind of got my spark going and how it could possibly be utilized within the U.S. financial industry, specifically banking, which is what I come from. Now, Telcoin started in 2017. They created their own native token, Tel, which you can go out there and buy right now, along with their own digital wallet, which is still, which is out there. You can use, download, and utilize. And around 2020, our founder and CEO, Paul Nooner, was talking to his old college roommate from Notre Dame, then State Senator Mike Flood, now current Congressman Mike Flood. I'm kind of looking at going to Wyoming, getting into this because Paul, is a visionary, and he's kind of saw the future in it. And Mike's like, well, why go to Wyoming? Why don't we do this in Nebraska? So then, Mike was a state senator, and he brought up the Nebraska Financial Innovation Act to the unicameral here, and it still blows me away because most people who have any background in policy and legislation knows that a lot of times something new could take years to really kind of hash out. Yeah. And luckily for us, he had previously been a Nebraska state senator in the early aughts here, and did his time there, went away for a while, came back in, so he knew the process. And within that first legislative session that I went through, it passed. And that's kind of when I got introduced to Telcoin, because while I was president of a bank, I was also part of the Nebraska Independent Community Bankers Association, which is a trade organization here in Nebraska. And I was on their governmental affairs committee. And well, this was brought to us. And this was the first time I'd seen anything really like this. I'd heard what was going on in Wyoming. So we met with the Wyoming bankers, kind of heard what some of the hurdles they had. As you can imagine, this is early days of this type of crypto banking. And a lot of bankers, including myself, were quite skeptical at first, because this was new, it was kind of being shoved to us. We had never really read anything like this before, but within a couple of weeks, I'd done my homework, talked to a lot of people, talked to Telcoin, and realized that this is kind of the future of banking. This really could be, again, at this point, I had understood, like I said earlier, the blockchain and the implications of what that could do as a benefit for the financial community. And so I was kind of pushing, I was one of, I like to say, 2 bankers who were in the state of Nebraska who were kind of like, wow, this actually is going to probably be something. We might want to get behind it. Anyway, the bill passed, went through committee. It was signed by Governor Pete Ricketts, now current state senator for Nebraska, Pete Ricketts. And I was kind of at a point in my career where I was kind of looking for something new. And their legal counsel reached out to me, who I'd known for a great many years, and said, hey, would you be interested in running the operations, being president of this bank? I know you're looking for something. And I'm like, you know what, this actually might be a great thing to get a part of. So that's kind of how Telcoin was started and how I kind of got interested and brought in. So in 2022, I came on board and started the application and business plan for the Nebraska Department of Banking and Finance.
That was 4 years ago.
That was 4 years ago.
Yeah.
So the Nebraska Financial Innovation Act allows the Nebraska Department of Banking and Finance to basically regulate digital asset banks in Nebraska. So while we were starting up our institution, our banking side, the Nebraska Department of Banking was starting up their division, their side of their department to deal with this. So it was a lot of learning between both of us, a lot of going back and forth, because not only did we need to know what the department wanted from us, and not just in terms of what we were going to do as a product, but also kind of how we were going to run. We also need to know how they're going to regulate us, what kind of compliance needs we need. And when it came down to it, the application is basically a de novo application for a de novo bank, which to me was.
So for those that might not know, can you explain what that word means?
A de novo bank is a brand new bank. It's starting a bank fresh. Since the 2008 financial crisis, there's only been a handful of de novo banks, traditional banks in the United States, that have been granted because it became so much harder to get a charter. So you now kind of have a background of an idea of kind of the mountain we had to climb to go through this, because it wasn't just policies and procedures, what we're doing for our business plan, but also kind of the capital requirements and those things that we had to kind of get set in place to move forward. And those can be quite daunting from, let alone a small bank, a mid-sized bank, it would be, hard to do, but even, a large one on top of that, because you have a lot of time and resources you have to dedicate to it. So over those years, going back and forth, understanding what was needed from us, understanding on their end what we were trying to do, in February of 25, we got conditional approval after all those years, 2.5, 3 years of working on this, conditional approval by the Department of Banking here in Nebraska for the charter. And what that means is basically like, we've taken your business plan, we've taken your application, we accept it. You need to do a handful of other things, such as finalize capital, risk and stuff like that together, get our leadership team in order and whatnot. And a few months of that going through, making sure we cross our T's and dot our I's, we were finally in position to where they granted us the first charter in the state of Nebraska in November of 2025. The goal is to get everyday people into crypto, into stable coins. And it kind of goes back to our start of basically crypto started as this very niche area, stable, all type, not just stable coins, but all types of digital assets. And if you don't have a good knowledge of it or a background, it's kind of hard to wrap your head around if you're an everyday American consumer. And personally, I believe for the everyday American consumer to get into this realm, the banking industry is a great starting point because you have the U.S. financial industry behind you. You have the regulatory backing, you have the guidance, you have the federal government, which is strong. It's, if not the strongest in the world, it's very close. And where do people have trust? They have it in their financial institutions when it comes to money. Safe places to store their money, get money lent to them, invest in products. So starting up a digital asset depository institution with the regulatory agency, such as one for banking, in our mind, is a great first step to get everyday people who have no background in crypto, specifically stablecoins, into that marketplace. Digital asset bank. So what you will be able to do is you'll be able to apply for a bank account with us. Okay. So you go onto our app, you will be able to apply basic AML, anti-money laundering, know your customer, all that stuff that you would for a normal bank account. And you will be able to, once we approve you and one of our partner bank of ours, because we cannot hold fiat currency, so we have to be attached to a traditional brick and mortar bank. You'll be able to, once approved by both institutions, you'll be able to, let's say, ACH money into your bank account with that account, through our app to that bank. Let's say you do $500. Okay, this is basic. You mentioned product basic understanding. You'll wire in $500. Once it hits your bank account, it'll then be swept into a reserve account, where that's where the backing 1-to-1 of the stable coins. We will mint what we call our EUSD. That's our stable coin. We will then mint that to you, to your decentralized wallet. So pretty simple process. We call it minting. Money comes in. The money goes into the reserve account with the bank. We then mint on the blockchain EUSD into your wallet that we've approved. And then from there, you can utilize it however you want to utilize that EUSD, that stable coin. From consumer perspective, it will be like opening up a traditional, checking bank account. But at the end of the day, your balance will always be zero, because that money goes into the reserve account with the bank that we are custodian over, and all that EUSD goes into your decentralized wallet. So you are still custodying, the consumer is custodying themselves that EUSD. So you will have, like a traditional bank, you will get bank statements, but it'll always be zero because there's no fiat currency ever in that account outside of the pass through into the reserve. First place, as everybody or most people who are listening to this know, utilizing crypto is a fraction of the cost of transferring and moving around fiat currency. So this is a great question. This is a question I love talking about, because we are farther ahead now because of the passage of the Stable Act last year than I ever thought we were going to be at this point in time. As I said earlier, it takes a long time to get legislation usually passed through, especially on something new. It usually takes a couple years, a lot of, behind the door talking, trying to figure out, who's safe with what. But the fact that Congress passed Stable Act last year was huge. And that put not just the U.S. government kind of in the spotlight when it comes to cryptocurrency and specifically stablecoins, but also the banking industry, because you had a lot of people who were either cautious or skeptical over this realm of finance, all of a sudden going, okay, the U.S. government is pushing forward with this. We got to start talking. I've talked to so many peers, bankers across not just Nebraska, but across the nation, who out of the blue are like, okay, this is here. How do I learn more? Like, partner banks that we've talked to in the past are like, we're just not there yet. We're not there yet. All of a sudden out of the blue are like, hey, maybe we want to get into this, because it goes back to what I was talking about, the U.S. banking system in the first place. It is a very trusted institution as a whole. It is a very safe place to go for people to utilize, to save money and utilize different products. So the fact that banks are now looking at this going, okay, we have the backing of the regulators. Technically, hopefully the Clarity Act comes through here soon to help kind of define a lot of those different, it's not just, yield as people are talking about, but there's talks on, AML, KYC that need to be kind of ironed out. So the fact that we're moving this quickly in a good way, not like, fast, a lot of times people think fast or quick can, you can miss things up. But I think the way the policymakers have been going about this with the education they've been getting from the crypto industry on top of the traditional banking industry, because it's got to go together. And really understanding each other and the needs of each one's has been huge. I think we're going to see a huge uptick, especially once the Clarity Act, finalized and gets passed, not just within the crypto industry, but in, U.S. banking. Because all of a sudden the OCC, the Federal Reserve, FDIC has a basis to build their guidelines and frames, what they need for compliance and regulatory framework for us to all do this in a safe and sound manner. And again, I'm a traditional banker, so I'm going off of, what's the compliance aspect? What's the risk? What's, like how do we do this in a safe way that not only protects the banks, but most importantly, protects the consumer? That's our biggest thing, because if we don't protect the consumer, we're not going to have anything.
Yeah. No.
Or more importantly, the educational aspect, because that's a huge thing. It's not just with the bankers educating them, but also just the everyday consumers understanding what this means to them in their everyday lives. I mean, we still got a ways to go. We're still working on, point-to-point transactions for businesses. The ability to take, one thing, because we're trying to lead the way in a lot of this. But I think once the educational aspect happens, they'll understand the ease of use, the low cost, the speed of these transactions moving, and honestly, out of all of it, the number one thing I think is the transparency in it all.
I agree with you. Well, thank you so much for being our keynote for today for our Global Summit. We're about to go right now to our first panel, which is all about institutional adoption and the different ways that institutions are navigating that with the different products and services. So thank you so much, Patrick, for being here.
Thank you.
So definitely, Matt, I know that you and I've talked about this for a while. There's a lot of change that's happening for sure. And Patrick kind of crystallized that in talking about, a very unusual situation, a digital asset bank. So we would like to welcome on today, right now, our strategic partners from Rio Digital. We have Lonnie Dizon and Anthony Diaz. How are you doing today, guys?
Oh, wonderful, and happy to be here.
Yeah, so both of you are global entrepreneurs, and you've been working in a variety of businesses for over 30 years and crossing over many oceans, from Japan to Europe to Canada to the United States. I know we're going to be seeing a lot of the projects today through the various little shorts that we're going to be highlighting and talking about. But what would you like to kind of, Anthony, since you're going to be a moderator later, I'm going to have you kind of share first what your thoughts are, because Lonnie's going to be moderating our first panel. So Anthony, you just heard the keynote. What are your thoughts?
Well, it's interesting what he said. I share his pain. He was 5 years, was it? He was saying that he was in with that application process, and we share a similar timeline, but this year is finally the flashpoint that we're going to actually launch all our initiatives, and it's gratifying to see that the world is coalescing around ultimate mass adoption for crypto. And that's always been our mantra, is mass adoption. Make it easy enough for grandma. And if grandma can do it, then the rest of the world can do it. And so that's what we've been working on here in Japan. And we're really excited that BLI is also spearheading that with us in awareness around the world.
Yeah, we're definitely excited. I know that you're going to be moderating the panel dealing with ConsumerFi and how there's a lot of different protections that are in place, and also products and applications. So we're going to have you kind of off stage right now. Okay. And that way, Lonnie can start to moderate the institutional side of where we're going. Lonnie, welcome. How are you doing today?
Oh, I'm really doing really well. Thank you. Yeah, this is very exciting, and welcome everyone to this panel.
So for everyone who's on the panel, as you are being welcomed in, why don't you, and also, shared your question for speaking, also share a little bit more about who you are and, what your, the projects that you're fostering. Because again, each of you is within a different niche and area, and we definitely want to highlight what you're focusing on. So I see that for some, Lonnie needs to come back on stage, but why don't we start with Jordan, why don't you share a little bit about your background and how you got here? And that way we'll start the panel off.
Yeah, of course. Jacqueline, appreciate it. Matthew, thank you. Londi as well. Appreciate you guys having us on today. A little bit about my background. I spent 10 years as a private banker at Fifth Third Bank here based in Cincinnati, Ohio. Towards the tail end of my time there, I left and went to Coinbase, was on their institutional prime brokerage team for just under 2 years. In the last 3 years, I have headed up global institutional strategy as well as partnerships here at Global Stake. Global Stake is a Web3 infrastructure firm that primarily services customers in a variety of yield services as well as infrastructure in Web3.
So Lonnie, would you like to go ahead and start? I know that you're back on stage now. That's what happens.
Yes.
Live situation.
Yeah, I apologize. Can you hear me?
Yes.
Hope you. Okay, perfect. Well, welcome everybody. In this panel today, we're going to be discussing what actually drives institutional adoption. Just a few years ago, that felt really uncertain because many institutions were watching the space very cautiously. But today, as we can all see, that's clearly changing. And so today's discussion is going to be about that shift. From interest to implementation and how trust is built and what makes digital assets real and usable for institutions. And so I'm really looking forward to having this discussion with all of you. Great group of experts here. And so I think we want to continue with the introductions. Okay. So let's go ahead and continue with the introductions and have, the next person introduce himself. How about James?
Yep. Hello, everybody. Quick little background about me. My name is James Knapp. I'm a CPA. And Jackie, I appreciate you welcoming me to the panel today. But a little bit of background. I came from PwC. I then left for an individual tax firm specializing in individual tax on the crypto side. So I actually practiced doing the recon, being in the weeds, and then I actually left for a tax compliance firm for wallets, exchanges, individuals, and businesses, and I lead their North American partnerships currently.
Nice. Okay. And we'll next have Sulaiman.
Hey everyone, yeah, Sullivan here. Hi Jackie, hi Matt. Hope you're both well. So Sullivan here, I support MasterCard at a global level, sort of working on all of their global initiatives around legal side of things. So I'm a lawyer by trade. Previously, I worked at a crypto startup. Also did some work on the traditional finance side of things, so in a brokerage, which also did sort of crypto derivatives. And then before that, before crypto, my background was primarily in sort of traditional finance. And I I support DARA as well, which is quite an important function, which I should mention, and that's obviously supported by Jackie and Matt as well.
Nice. Okay, and Jennifer?
Hi everyone, so I'm Jennifer. I'm the head of legal and compliance at TwinStake. So TwinStake is a non-custodial staking provider. We serve financial institutions only. And prior to that, I worked at the Boston Consulting Group as a legal director, and before that, in the aviation industry, so completely different.
Okay, nice. And Marjolaine?
Yeah, thank you so much, Lani, and thank you so much, Jackie and Matthew, for having me. I'm a partner at the international law firm Bird & Bird, and specializing in particular on regulatory projects on a European and international level, with a clear focus on innovation and technology. I think perhaps the more important reason why I'm here is that I'm also the project leader for the European blockchain regulatory sandbox, responsible for setting up the sandbox and operating the sandbox over 3 years, so from 2023 until the beginning of this year. A quite intense project, an initiative of the European Commission, and of course we had wonderful use cases in that project, and I would love to discuss them with you, and there's too little time today, but I'll do my best. Thank you.
Okay, great. Well, what we're going to do is we're going to start with our first question, and we're going to bring on Jordan and ask him the first question, which is beyond policy clarity, what is the key factor that actually converts institutional interest into live digital asset allocation? And what role do trusted partnerships play in that process?
Yeah, no, I appreciate it. That's a good question. I would say the key factor that we would probably all agree with is confidence execution. So institutions really feeling ready to move forward. As we've noticed, many institutions are already intellectually interested in digital assets. They're familiar with ETFs. They relatively understand the asset class. They've had certain teams maybe internally pursue it and try and digest it and understand it. So they might not be experts yet, but they're looking into it and they're well versed. They understand the long-term relevance of crypto at this point, we can agree. But I would say interest really only turns into live allocation when they believe that they can really participate in the space from an institutional standard point of view. And as we would all agree on the call, that's true institutional risk standards, real governance standards, reporting, as well as operational control. So to the last part of your question, where do trusted partnerships kind of come into play? I believe that they're very critical because institutions don't want to piecemeal everything and try and wing digital assets as they enter the space. They're not trying to throw together custody, infrastructure, validators like myself and TwinStake, reporting, legal review, what have you. They're not trying to hodgepodge all this together. And then on top of that, train their teams internally and educate them all on their own. They're really looking for a stack of partners that already work in the space, that are already cohesive with each other, that already trust each other, and make their lives easier. So, partners that reduce that immediate friction, that help them satisfy, their internal committees that they're trying to showcase all this to, really lower the stress levels of their background due diligence that they need to do, and ultimately make deployment just quicker and easier. So I guess in summary, I would just say that, the real institutions are looking for counterparties that have strong security, very clear, economical transparency and standards, as well as the ability to integrate into existing workflows. So while policy today in the United States is helping us to kind of open the door for institutions to come in, at least from my seat, I would say institutions are starting to come in mostly because of the trusted partnerships in the space, the marquee names that have led this industry for the last decade plus, and a lot of us that have come along and provided real institutional trust to where these institutions look across the table and see many of us on the call and say, hey, I trust these people, I trust their infrastructure, I trust their processes, and we know that they're going to work within our operational workflows. So I'd say confidence.
Oh, well, good. Those are really important points. And yeah, confidence is definitely critical. Institutions definitely don't allocate because they're interested, but they allocate when they feel safe and have the right partnerships and have that confidence and see the proper regulations. So is there, I'm curious if others are seeing that. Does anyone else want to add to that?
Yeah, I can add to that. I think everything that sort of Jordan said hit the nail on the head. I think an additional point is the operational trust, right? Really, when you have big institutions, to move from interest to allocation, you need to have the regulated access, sort of credible custody, clean execution, sort of internal governance, and confidence that the product that's being provided can fit sort of existing risk and control frameworks as well. And I think those trusted partners or partnerships matter, right? So banks, custodians, and market infrastructure providers and technology partners. I think now we're getting at a point where you're de-risking at the point of entry, which kind of makes digital assets look, less like an experiment and more so like a sort of investable workflow. But I would generally agree with everything that Jordan said.
Yes, yeah, definitely the de-risking, that's definitely important. Anybody else would like to add onto that?
Yeah, perhaps a short comment from the European Blockchain Sandbox part, and that is that what we saw happening over the period of 3 years of the project was that the regulatory and legal part was becoming more and more part of the setup of use cases and innovators. And that was really a very good development, an encouraging development, because what was perhaps sometimes happening before was fantastic innovations being developed, and then at the end of the road, let's have a look at legal and regulation, and then, oh boy, now we need to change this and that, and now it's becoming complicated, and we better hide away from regulation because it's not contributing. And that is, of course, not sustainable. You cannot build a big growing business on that basis. And what we saw in the sandbox was that the use case, and there were many use cases participating in the sandbox, they really took regulation seriously. They factored that in from the start, and they gained confidence in compliance. No longer regulation to hide away because life's becoming impossible, but just to look into it and see how it's going to work. And that is, and of course, it's not the end of this of the road there in the development, but it is definitely a development.
Yes, definitely. Regulatory, when we've been in this space since 2012, that was exactly the direction that we knew needed to go, which is why we're in Japan building upon some of the strictest regulations in the world. So I definitely agree with you, Marjorie. Thank you. And why don't we go to the next question? And once institutions adopt and they feel this clarity, then the next step actually in entering is how they structure that with how they structure that. And so within investment products and entry, what I'd like to do is ask James, how have Bitcoin ETFs and other digital asset products fundamentally changed the first year strategy for firms and their tax planning strategies?
Yeah, no, absolutely. And yeah, that's been a significant change when they introduced like IBIT in 2024. Because when you hold Bitcoin directly in a self-custodial wallet, the IRS treats it as personal property instead of security. And that distinction is everything, because previously the big advantage, what I like to call tax alpha, is the wash sale rule didn't apply. So if you bought in at a certain basis, it dropped in basis, you could sell it, claim the capital loss, and then buy right back in. That is great, but it creates an absolute tax nightmare, especially with people doing high volumes of transactions, things of that nature. And with an ETF taxed as a security, you have a lot more flexibility. So I could dump it into an IRA, a Roth IRA. It's a lot better for someone that's just buying and holding, because with an asset that 10x's, you held it in there for 30 years, you could get out tax-free. So from the side of an institution, I mean, you just have a lot more flexibility, treat it as a security. It's much more clear on how to handle it. And while you sacrifice that tax alpha, you could really have a lot more flexibility on where to place the Bitcoin and have exposure to it, without having the compliance nightmare of having private keys, having the actual wallets and exchanges, and doing stuff that only a crypto native would know how to do.
Mm-hmm. Yeah, definitely. And these products like the ETFs seem to have made the space feel more structured and familiar, which is what institutions need to see early on. And not only for institutions, but it is a bridge for people that are new to the space, where they see products that are familiar. So yeah, so that was a really strong point. Thank you. Are there others that want to add to that point? Do you see institutions becoming more confident because of these entry points and familiar products like the ETFs?
I can jump in here. I would say yes, definitely from our vantage point, offering different yield services. We're seeing more institutions that are, they've been watching the ETFs for a while, and the ETFs have started to evolve. There's now staking ETFs, and you've gotten to the point now where some of these ETF providers are wanting to launch ways to make the asset allocation into Bitcoin maybe a little bit more productive. So there's starting to be institutions, at least the early ones, that, to James's point, we're excited. Hey, this is a familiar wrapper. I feel like I can get exposed to this. But now that I'm exposed, maybe how can I get a little bit of yield within this Bitcoin space? So I'm starting to see that, at least initially, in the space.
Mm-hmm.
Yeah,
definitely.
And that actually ties to another instrument called an RWA, which is a real world asset. You could tokenize anything. And with the yield, I mean, formerly you would receive distributions, which are taxable events. You're basically paying 37 cents on the dollar. And really how it kind of serves like a zero coupon bond where the token just appreciates. And then at the end of the day, you can just pay a capital gain when you decide to get out. So it's a really fundamental difference that saves the taxpayer a lot of money by utilizing that instrument.
Yes, definitely. Yeah. Go ahead, Jennifer.
Yeah, I wanted to jump in from a legal and maybe structural perspective. It seems like ETFs have been quite transformative because they allow institutions to access digital assets through fully regulated product wrappers. And so rather than engaging directly with on-chain structure. So I think it seems that from a tax perspective, it shifts the analysis away from crypto-specific complexity towards more maybe existing reporting and tax frameworks. I mean, James, you're the expert, but that's my feeling.
Yeah, definitely. Anybody else want to add to that point? Do you feel that familiar or these types of financial products are making adoption a lot easier, with the institutions as well as with people?
Yeah, perhaps a short comment, and that is then from perhaps a European perspective, but these are, of course, very important instruments also in this part of the world. And what is interesting is that in regulation, the regulation is shaped in such a way to actually support this development. So if you look at, for instance, an instrument is MyCar, that is EU-wide, well, that in itself is already a big advantage. So you don't have to go through 30 different countries. You have one regulatory instrument. And for instance, stable coins, and then the question is it EMTs, ARTs? Well, that is, I understand that's European terminology, but there's similarities there. They find a home. And if you find a home in regulation, you find clarity and legal certainty. And that is very helpful.
Yes, definitely. And so I'm sorry, go ahead.
No, I was finished. Thank you.
Oh, okay. Okay, great. Well, wonderful answers. Thank you very much. Yeah, I think that I think we all believe that these products and these familiar products are helping, confidence in institutions and in people. And so thank you so much for your answers for that. And so now one of the takeaways is that, stable coins too, turn digital assets from something that's speculative into something that's usable. And same thing with ETFs and these other products. And then when we move into how these assets actually, function into the real world, that's where we're leading to next. I'd like to address the next question to Sulaiman from MasterCard. How is the growth of stablecoins changing the way payment giants view emerging technology?
Yeah, Phil, great question. And I think, unfortunately, I can't speak about all payment giants. I'll try and speak about it from sort of one perspective, given my current sort of position. But I think if you read the news over the last few days, you'll come to the natural conclusion in terms of, what major payment institutions are doing, sort of including MasterCard as well. But I'll try and keep it as generic as possible. So in terms of like some simple framing, right? I think stable coins, they're no longer this crypto experiment, and they're really moving towards becoming, or have become, this kind of programmable money realm. And I think that shift sort of fundamentally changes how payment giants, whether it's us or any of the other ones, which I won't name, think about this emerging technology, right? I think across the industry, the question sort of moves from should we engage with this to more about where do we kind of sit in the stack. If you take a step back, payment networks sort of historically operated on top of traditional banking rails. Think about ACH, SWIFT, and they were acting as those intermediaries that move money between parties. I think stablecoins completely changed that model, right? They introduced near settlement, they operate 24/7, they're inherently borderless. So what you're seeing now is not just a shift, but a shift in mindset, from intermediating transactions to actually orchestrating the movement of digital value. And I think that creates quite a strategic question for all payment players, whether you're big or small. Sort of if the value can actually move natively on chain, where do we fit in, right? And I think another thing that's interesting is sort of how stablecoins are shaping the way, whether it's us or any other payment provider, how you actually evaluate emerging technologies sort of more broadly. So they effectively now become sort of this anchor use case. So when firms sort of look at blockchain infrastructure, I think it's no longer sort of about scalability or throughput. It's whether that infrastructure can support, compliant, high volume stablecoin flows. And if you actually break that down further and start thinking about digital identity, the focus now becomes, can we actually attach like verified credentials to wallets, sort of in a way that satisfies KYC and AML requirements. And then you have the other side when you take a look at smart contracts, right? With smart contracts, typically the emphasis really is on programmability. And that's something we work on as well. How do we actually enable automated payments, escrow, conditional settlement in a way that's reliable and enforceable and scalable, right? So I think instead of experimenting with this tech in isolation, you're sort of asking a sort of new question. How does this sort of plug into a stablecoin based payment flow as a whole? And that's sort of the shift that's becoming sort of clear across the industry. I think also from a traditional payment perspective, one of the biggest focuses, and even for us, is sort of trust and compliance, right? Stablecoins effectively, they don't remove the need for regulation, if anything. It's intensified even more. You still need, robust AML sanctions controls. You still need transaction monitoring, consumer protection, dispute frameworks. And I think these are areas where established payment networks have probably the biggest or like a real advantage. So I think what you're seeing is more of a repositioning. Stablecoins and payment providers aren't necessarily competitors, but payment providers and major institutions can be that trust layer that sit on top of these sort of open networks. And that might look like something like, verified wallets, permissioned access to certain rails, on and off ramps, which are compliant, that embed compliance directly into an end user journey for institutions or even retail end users. And I think that's where really the scale happens, not just in enabling stablecoins to exist, but making them usable in a sort of regulated and mainstream environment. And in addition to that, I think there's this real commercial shift happening in sort of parallel as well. If you think about how traditional payment models have been built with things like interchange, FX, margins, settlement fees, I think stablecoins compress a lot of that. They reduce transaction costs, they accelerate settlement, remove the need for some of these traditional intermediaries. So you have to kind of look at where the value is being created and where you can actually sit in. And I think sort of on a broader, just to finish off here, strategic reality of sort of what I see, there's really not this stablecoin versus payment giants thing happening. So I don't think they're necessarily trying to compete with one another. There's an increasing sort of need to actually collaborate. So that means partnering with issuers, enabling some of these settlement flows, and actually embedding these capabilities into existing sort of acceptance networks. And ultimately, I think the opportunity is not choosing between sort of traditional finance and blockchain. It's actually bridging the two, combining the scale, the trust, the reach of these networks with sort of efficiency, programmability that these blockchain-based systems sort of bring.
Yes, definitely. Very great points. Thank you for that. Yeah, with the stablecoin, that this is where it actually starts becoming real. How money actually moves, and for between people across borders and in everyday situations, and the stablecoins help that, especially for institutions. Stablecoins are so important because they introduce the predictability and the efficiency and control into the digital asset transactions, and they remove the volatility risk while still enabling the instant settlement and the lower cost and so forth. So yeah, definitely stable coins are extremely useful, foundational, and part of the future. So thank you for that. And so before we move on to the next question, is there anybody that wants to add to that?
I do want to raise something from the tax infrastructure side on this, that I do have a frustration with the current tax law here. Although we all know a stablecoin is pegged 1-to-1. Transacting in large volumes, seeing institutions jump in, even small and medium-sized businesses, that all needs to be accounted for on a Schedule D, which is really, we're seeing an explosion on our end of the business because people are jumping in feet first, not understanding that tax consequence, and all that might change with some of the upcoming legislation being passed. Like, you need an infrastructure to really keep track of all this. So when the IRS comes knocking at the end of the day, you have a solution. And that's really what we do. We transact extreme large volumes of transactions, give you the tax reports at the end of the day. But that's a blind spot I see talking to small, mid-sized business owners, and even sometimes large institutions. They don't consider it, which they shouldn't have to, in my personal opinion. But it is what it is.
Yes, great point. Thank you for that, James.
Yep.
And so, so far what we're hearing is that, institutional adoption, is unfolding. We've got these products that are helping with that. And it's unfolding step by step. And so the takeaway too is that institutions enter adoption faster when they can use tools that they already understand, and same thing for people too. And so the next topic that we're going to get into is about clarity and how safe it is to operate globally, which is also very important regulatory wise and for institutions. And so this question is for Jennifer. Looking at global markets, where are we starting to see real regulatory clarity for institutions, especially around areas like staking and DeFi?
Well, Annie, that's a very broad question, but I think if we look at digital assets from a financial institution's perspective, I think the key question today isn't really whether crypto is regulated, because we can all see it increasingly is. The real question is which activities can institutions actually engage in with legal clarity. And I think that matters because for a long time, actually, crypto operated in a relatively uncertain regulatory environment, and we're only now starting to see that alignment emerge. And so as we've seen that evolve actually real time, this week there was a long-awaited SEC guidance on how security law applies to crypto. I'll tackle that a bit later. But to answer the question, I think I can give a brief overview of like the EU, US, and UK frameworks and explain briefly what we mean by staking and DeFi, because the regulatory treatment really depends on how those activities are characterized. And so I think not all on-chain activities are the same. And so some look like traditional finance, such as lending, trading, whilst others, I think, are more like closer to infrastructure, actually helping run the network. So I think, yeah, that distinction drives how regulation is applied, or tend to drive how regulation is applied. And that's also probably why staking has become one of the first areas institutions are exploring, because it's tied to network participation rather than complex financial products. I just want to give, a few numbers about staking, because I don't think it's a niche activity. Today, around $290 billion of digital assets are staked globally, with projections reaching up to $2 trillion by 2028. So it's really a key activity. So maybe to just introduce staking for those who are unfamiliar, it is the process by which assets are delegated to validators that secure a network in return for protocol rewards. So I think the key point is that those rewards arise, in certain part of staking from participation in protocol rather than from efforts of a third party. I think this is central. It's a central framework, like the Huawei test in the US. It's a test that enables to determine whether something qualifies as a security or not. And so I think staking is generally closer to infrastructure participation than investment activity. But of course, it depends on the models. There tends to be two models. There's the custodial model where assets are held by the provider, and that clearly falls within existing custody and safeguarding frameworks. Whereas non-custodial staking is the model where providers deliver infrastructure, but assets remain with the client or their custodian. And that's the model we follow at TwinStake. And then the distinction, I think, is very important because regulation often turns on who controls the asset and who's providing the financial service. And before actually giving a brief overview of the jurisdiction, I think it's also super useful to briefly define decentralized finance. And that's essentially financial services performed on chain through smart contracts rather than intermediaries. And that's where things get a bit more complex, I'd say, from a legal standpoint. And it's also more nuanced. If I take the vaults as an example, where users actually deposit assets in a vault, which are deployed into strategies like lending or liquidity provision, economically, that can start to look like a fund or a managed portfolio. But legally, it's critical to distinguish roles, I think. So you have, infrastructure providers, you have curator strategists, and then you have asset management-like actors. And I think regulation depends where you sit on the range, right? And I would say infrastructure is generally further, sort of lighter in terms of regulation, whereas, if you get into the space of more strategy and product layers, this is more likely to trigger security funds or asset management rules. So I think DeFi is not one thing, it's a stack of function, and there's a lot in there. So I'm going to try, because I know we don't have a lot of time, but I'm going to try to give an overview. So I think starting with the EU, with MiCA, I think that MiCA provides the clearest regulatory framework today, and it covers intermediated services like custody and trading with strict safeguarding obligations. And I think custodial staking fits relatively well, clearly within that framework, whereas non-custodial models are less clearly defined. Actually, MiCA doesn't mention staking or non-custodial models. It really regulates the custody. For DeFi, I think MiCA is more limited, and it focuses on identifiable intermediaries. So infrastructure may sit outside, but vaults-like strategy-driven activities can raise, I would say, fund or portfolio management questions, and that's why we're already seeing discussions around MiCA 2, and we hope that these will get clarified further. I think in the US, we're seeing a shift towards greater clarity, and historically everything has been analyzed through the Howey test, as I was mentioning earlier. But just this week, the SEC issued an interpretive guidance applying, that framework more explicitly to crypto. And importantly, I think it clarifies that protocol staking in its core form is not a security offering, so that is key, and that is related to staking that reflects pure protocol participation rather than managed product, and I think that's significant. It recognizes staking as a network participation and not an investment activity. But in DeFi, if I look at the DeFi side, the analysis I would say still turns on role. Infrastructure may fall outside of the regulation, while strategy or product layers bring you back into the security analysis. So going back to Europe, if I look at the UK, I think the approach in some ways is more stringent. There is a draft crypto regulation, and where staking itself is being brought into the regulatory perimeter rather than relying primarily on custodial versus custodial distinction. So under the Financial Services and Market Act framework, regulation is based on activities and function and not labels. So the activity itself becomes regulated. And I'd say in DeFi, the focus will be on role again. The closer you move towards strategy or asset management, and the more likely you are to engage in some financial promotion, conduct rules, or fund regulation. So the UK reinforces a strong functional approach, I'd say. So as a key takeaway, and maybe to wrap up, I think across jurisdiction that the pattern is broadly consistent, and clarity emerges first where activities can be sort of mapped to existing legal categories and with role clear with clear roles and responsibilities. And staking often fits within that. DeFi is a bit more nuanced because it spans multiple roles. I think for financial institutions, that means that engagement is easier, where activities can be framed as infrastructure participation, and a bit more complex, where the model resembles asset management or product structuring. And what this also means in practice for staking providers and also for DeFi participants is that there is an increased need to be clear about how activities are structured. And ultimately, I think, and these will be my last words, the distinction is not really crypto versus traditional finance. It's whether an activity is infrastructure participation or financial intermediation. And increasingly, I think regulation is being built around that distinction.
Yeah. Okay. Well, thank you so much for those insights. Yeah, definitely. We're seeing a lot more regulations coming on board globally. We're seeing a lot of clarity here in Japan, Singapore, Europe, like you mentioned, and the UK. Japan and Singapore are really leading structured frameworks, and like you said, Europe with MiCA, and UK is moving toward a more defined regulatory regime. So, and US, of course, is also evolving. So, yeah, we're seeing a lot of regulations, happening globally. So I'd like to pass on the next question to Marjolaine. And the question is, what lessons were identified during the recent EBS regulatory dialogues? And from a global perspective, what partnership models are proving safest for adoption?
Yeah, thank you so much for these very, very relevant questions. I will keep it very, very short.
Take the time that you need.
No, thank you so much. Regarding the lessons learned, so the European Blockchain Sandbox regulatory dialogues were confidential and informal conversations between regulatory authorities and innovators. They were also held in a constructive setting, so identifying certain regulatory challenges, but also identifying the solutions in combination with those challenges. And then the results, everyone was comfortable with what was being discussed, are published in best practices reports. So they become available for the wider community, which is of course very, very important, because that's what it's all about. Would like to thank Jennifer a lot for this very clear explanation and comparison. Perhaps I could add, because we had to go through the regulatory analysis with all these use cases, 3 times 20 use cases across the whole project. And for the financial sector regulation, we did many of them. We had a kind of menu of topics that we need to address first, second, third, and then fourth. First, very importantly, was qualification of the tokens. To understand in what regulatory instrument you need to look, where is the home for those tokens. Secondly, qualification of the services. What kind of services are being provided by the use case? And are they regulated or not? Are they exempted or not? Important second question. Third important question, qualification of the actors. Very often these use cases are partnerships, as you mentioned in your introduction. They are partnerships. Who is who in that partnership? Who is actually performing the service and who is not? And then we came across the fourth, actually, cohort of questions, and there are very interesting chapters in particular the third cohort best practices report. And I mentioned 3 really thorny topics there in qualification of the actors, where I think we really enhanced clarity, legal clarity. The first is the notion of technical service provider. There's an idea, oh, I'm a technical service provider providing services to some other operator who is providing services to customers, and now I'm only a technical service provider. I'm outside any regulation. And that is not per definition the case. You really need to look at that carefully. So we have important, I think, observations there in the report. The second important element is smart contracts. Jennifer, I think you mentioned smart contracts, hugely important in this sector. Smart contracts need to be analyzed in itself under regulation. Smart contracts are performing something, a service, a function, something. And they cannot be disregarded under regulation. You need to take them on board, and they are relevant for the qualification, regulatory qualification. So we looked into that. We also looked into security and safety of operation of smart contracts. That is, of course, also hugely important. If you have a bug in a smart contract, that is really a big threat. So we looked at certification, verification of smart contracts. Also, I think a very interesting and a chapter in the best practices report. And then the third thorny topic that we addressed in the dialogues is what is fully decentralized, and is fully decentralized out of scope for regulation? Is peer-to-peer, per definition, out of scope of regulation? Well, the answer is no, by the way, not always, but fully decentralized. Well, it's probably known to many in the audience, and definitely under the panelists. Fully decentralized is mentioned in MyCar as being out of scope. Fully decentralized is out of scope. But then the big question is, what is fully decentralized? We have a separate chapter again in the best practices report, and there's not enough time, although you are very gracious, but there's not enough time to go through that. But what I want to perhaps mention, and very important observation, is that the fact that we were able to include chapters about these thorny topics in a best practices report in cooperation with innovators and regulatory authorities, that in itself is an encouraging fact, because that means that parties are there to help innovation, to help to make this work. So that is one thing. And that if I have one more minute, I would like to share one further observation, because that was what kind of partnerships were, what we saw happening. So that in the sandbox, we had 3 cohorts of each 20 use cases. They were selected on the basis of an application and selection process. We had to go through a very serious selection, and that says something for each cohort. That says something about the market. There were so many promising use cases there that there had to be a serious selection in each cohort. The selected cohorts of 20 use cases each were also very interesting. One of the selection criteria was maturity of the use case. So we had relatively mature use cases in each of the cohorts. Validated proof of concept was the bare minimum. That was an entry criterion. All use cases met that criterion, and what we saw happening in the course of the 3 cohorts, that the use cases became more and more mature. That says something about the market developments, and actually the core of this event and panel. What was also very interesting was that in the second, and in particular the third cohort, we saw the combination of technologies really becoming very apparent. It was not only blockchain DLT, it was blockchain DLT in combination with AI, in combination with IoT, in combination with cloud computing, often a combination of everything. And that, of course, that raises additional regulatory questions, but it is also key to innovation. Third important development was, and then I'm going to stop. Third important development, that it was no longer, the financial sector was, of course, very prominent already from cohort 1. In cohort 3, it was again very prominent. But what we saw happening was that other industry sectors also became relevant in the third cohort. We had 2 use cases in energy. We had a very interesting use case in healthcare. We had interesting use cases in supply chain management, verifiable credentials. And what was even perhaps more interesting was that those use cases, once they become operational and on the market, they are also going to become relevant under financial sector regulation, because they want to earn a business. And how are they earning a business? They are looking at stablecoins to help running that business. And there we are. And that is why in the third cohort, we even had, I think, 11 out of 20 use cases that were relevant under financial sector regulation. And that was not because they were all crypto providers purely, but there were also the combinations of use cases in other sectors that wanted to use stable coins, crypto, to be part of their business. We also saw interesting combination. The use cases are not only one single company, they are very often consortia. Who were in the consortia? Not a one-size-fits-all, but we had a number combining traditional finance, so traditional banks, and DeFi, so the new providers in the market, teaming up in one consortium. We had consortia where there was a separate partner in AML compliance, focusing on that. Separately providing the platform, separately providing identity checks, the wallet providers. Quite substantial consortia, but I think that is, well, those were very good use cases, promising use cases, selected for a reason, I would say, in the third cohort. And well, when you ask about the link between traditional finance and DeFi, well, we saw it happening in the selection of the cohort. Thank you so much. And
Sure. Thank you for your insights. Thank you for your insights. And yes, definitely, as you said, the use cases already exist, from payments and settlements to tokenization and trade finance. But, the focus now is on scaling them responsibly through strong partnerships and clear regulatory frameworks. So, thank you all for your insights. As we wrap up, this panel was about institutional adoption. And as we know, I think we can all agree that institutional adoption is no longer a question if it's going to happen, but it's a question of how they can participate responsibly. And we're seeing that infrastructure, regulation, and market demand are now beginning to align, and we're seeing a shift from exploration into real implementation, but it all begins with trust. It's the trust that comes from clear rules, reliable systems, and the right partnerships. But thank you so much for all of your insights. It was wonderful to have this discussion with you all today. Thank you.
Yeah, thank you everyone for being on. Thank you, Lonnie, for moderating. We are going to have a short commercial while we bring our second panel on, which is all about global trends and other areas in this area that we are going to be speaking about. We're a little bit behind, but we would not stop this conversation because there was such solid information here. So everyone, thank you so much. We're going to pop you out and we're going to see our next panel soon.
Thank you.
Welcome, everyone. We have our next panel assembling, and we have our, let's see, we have everyone here, so that's wonderful. And our moderator today will be Eric Guthrie, who is both a partner at Cogent Law, along with myself, and he's been in the space for many years. He's also an author. And Eric, I'm going to let you lead the way.
Jackie, real quick before we get going.
Thank you,
let me add
Jackie,
the
and thank you,
disclaimer.
Matthew. I'm Eric Guthrie. Like Jackie was saying, I'm a partner in the Coaching Law Group. I'm the author of Blockchain or Die, and the recent, just released, Blockchain or Die Harder, both available on Amazon. But more important than those books is our panel today. We have a wonderful panel. We're going to be talking about global trends, digital asset holdings around the world. I'm going to make a brief statement, and then I'm going to ask the panel to introduce themselves. As we navigate this great convergence of finance and money and law and business, different parts of the world doing different things. North America, Europe, Asia, Africa, all doing different things in this space. Our mission today is to unpack that in international regulations, tokenization, national security interest, and stablecoins. And I know it's going to be a robust discussion. We have a world-class panel of experts that are going to tell you their expertise, give you their ideas and thoughts, and they're going to bring some novel ideas to this discussion. So without further ado, I'm going to have the panel give themselves a 30-second introduction, including where they do business in the world, starting with Harshal. Harshal, the floor is yours.
Yeah, thanks, Eric. Thanks, Jackie, Matthew. Thank you for having me. My name is Harshal Agarwal. I'm basically a partner at Tradfi Advisors, which is the name of my firm. We are a legal consultancy, mostly focusing on crypto and financial services. We focus on mostly the entire GCC and also on corporate structuring for dedicatedly for crypto services. Also assisting them with any form of licensing or legal support that you need to function here in a regulated manner. My background is that I used to work as a regulator before joining TLP at Vara, which is a dedicated crypto regulator. More on that, I guess, in the speech, but glad to be here.
Thank you, Harshal. And what do you primarily do business?
The UAE, United Arab Emirates.
Got you. Thank you, Harshal. Next up is Wook.
Nice to meet you, everyone. My name is Wook Lee. I'm CEO and founder of Edena Capital Partners. We are working with the worldwide governments. We are focusing on the sovereign assets to the liquidity markets. And we're trying to develop fully AI-driven investment model for the sovereign assets for the investment.
Thank you, Wook. And what do you primarily do business?
Actually, I don't know where's my primary business now because I travel the world every time, but I can say Asia is my primary location.
Got you. Thank you, Wook. Carol, you're up next.
Hey everyone, I'm Carol House. I run a strategic technology and geopolitical risk advisory practice called Penumbra Strategies. But most people know me from, I did 3 tours at the White House, including twice at the National Security Council, and also at FinCEN, the US anti-money laundering regulator, where I led crypto and identity and cyber policy for many years. And I chaired the CFTC Tech Advisory Committee in the US and have served on advisory boards for lots of different financial regulators and others. I've worked in venture, still advise a defense tech-focused venture firm, and really just like to focus on financial innovation, meets strategic tech, meets geopolitical risk, whether on the compliance side, integrating emerging tech. And I'm building out that practice. It's lots of fun to be out of government, so much flexibility. I especially focus in the US, but I've been building out and looking for more partners in the Pacific, as well as in Europe, and just having a ton of fun.
Great. Thank you so much, Carol. Next up is Bertram.
Yeah, hi everybody. Hi Jackie. Thanks for having me on this panel. I work with Arise. Arise, we are a stablecoin infrastructure company. So we have more or less a 360-degree solution for anybody who wants to issue their own stablecoin. We are based out of Denmark. Company has been existing for 9 years already now. So, and with us is the first step is technology first, and the second thing is, of course, compliance and regulation is a very, very big topic as well. So I'm happy to be here. I think there's a lot to talk about. So looking forward.
Here is Bertram. Thank you so much. And last but certainly not least is Nick.
Hi, Eric, and thanks for the invitation today. So I'm the Director of Revenue at SAS Mining. SAS Mining is a mining as a service product. You own the rig. We have data centers around the world in Ethiopia, Paraguay, USA, and Norway. And yeah, you own the rig, and you're taking Bitcoin, wild Bitcoin, straight off the network. Yeah, and so that's where I'm from. I operate in the US. Our customers are mainly US based, but all over the world, but predominantly USA and Europe.
Thank you, Nick. Appreciate it. So attendees, you can see the global breadth of diversity of this panel, and we appreciate you being here. Without further ado, we're going to get right into it, starting with Wook. Now, Wook, AI was already mentioned in the introduction, so your question is going to have some AI components to it. How is the tokenization of sovereign assets and the rise of AI-driven financial operating systems change the global institutional landscape in 2026?
Oh, thank you. I didn't know I will go first, but okay. Actually, I'm like the person, I don't like the word even tokenization or like very technology words. Because when I see the technology, when we use like the payment with our phone, when we do payment, but we don't know which technology is beneath the payment, right? So technology is like underneath the usage, and then people just use it very conveniently. I see as a technology as that. So my background is I worked in the climate change field and also worked with the UN almost 10 years, especially the UNFCCC. So I started with the carbon credit, and I was the guy that like when we were working, we were like, oh, I think there's no more that we can do. So I moved to the private equity side. And then I've been working with the worldwide government on sovereign the infrastructure projects and all of it. But however, this government projects, it's considered as always headache because it takes a long time to review and validation, verification. And when we talk long time, if the government changes, it's a long repeating discussion again. But however, but we're living in the AI world right now. So this verification, validation, all the legal aspects and others can be less in the time now. So it's not a headache anymore. So when it comes to the asset that we can invest more safely, then it becomes a premium asset. So in the left hand, we have the governments with the assets, but in the right hand, these days, when I see the tokenization, it was always repeating because people say why the tokenized assets is not going as well liquidity, but when it comes to liquidity, the financial institution search for the premium asset, not the junk asset. But what I see is most of the asset in the floating, what I can say is like looking like ghost assets, not really investable. But however, when it comes to premium assets in the traditional finance, premium asset don't need really this kind of ways to go into the liquidity. We can just go for the traditional way to invest. But however, so we need the premium asset in the tokenization field to make real liquidity. But however, when this premium asset are coming here, then we can make the real liquidity. So what we are facing now, there's a lot of momentum in this 2026, many governments changing their perspective on toward this, and we're trying to. We have like over 20 billion USD amount of asset in the pipeline, which is considered a premium assets. And what we are trying to do, we are stand by the financial investors in the capital call. So, but most of the asset from the developed country is good asset, but however, from the emerging market, even though the asset is good, the investment grade is low. So, which we discuss with the insurance partners to wrap up, then at least make it to A minus, for example, and then financial investors can easily invest in. And when these rails are prepared, what we're really trying to develop is we're trying to put on the AI on top of it. So from the verification, validation, everything, because I'm like the person, I see as always there's most of mistake is made from the human. So when we can eliminate the human mistakes, then there can be a much more lessening the risk. And when verification, validation, everything time can reduce. In the same time, most of the financial institutions are developing AI-driven financial investment model, but not yet. But gradually, step by step, it will be ready. And when it's ready, when the asset is on chain automatically, this financial AI-driven model will be according to like smart contract investment level, which region they want to invest, whatever, then it's connected as automatically. So we're trying to develop full AI-driven investment model. That's what we're looking at. But I see it's coming really fast, and this AI, everybody denies it, try to deny it's really happening really fast, but it's really, really happening fast, and slingshot has been made. So yeah, our Adena Capital partners, we're trying to not fight the waves. We're trying to surf the wave, at least in our field. That's what we're doing. Yes.
Woke, thank you so much. For someone that was not knowing they were going first, you give us a lot to unpack. I mean, you covered AI models, changes in government, user interface, safe investing, liquidity, human error, but most importantly, for the next question, which I'm trying to put together, it takes a long time for government to review the policies and the regulations and laws that are in front of them. So, Harshil, I'm going to come to you next, and I'm going to tee it up with this. You know, when we talk about regulations in this space, we're not just talking about blockchain. We're talking about crypto, we're talking about AI. Now we're talking about real world assets. We're talking about stable coins. So there's a lot of information that regulators and legislators have to really kind of consider when it comes to how to regulate this ever-growing emerging technology space. So in your opinion, which international regulatory framework is currently winning the race for clarity? And I purposely to say this, if any. Floor is yours.
Okay, so this is a packed question. So I'd say instead of naming a specific country, there are competing regulatory philosophies that go in this, right? And I'd say I'd focus on 3 to 4 regulatory philosophies to unpack this particular question, right? I'll start with Dubai, where I am, and I was most intimately familiar with the regulatory regime, right? And also the reason I want to start with this, because they've done something quite unusual, right? Back in 2022, Dubai came up with the idea of setting up VARA, which is the world's first dedicated crypto regulator, right? And only in this short period of time, they've been able to give out licenses to 40 plus licensed firms, which includes names like Binance, OKX, Bybit, etc. Right? Also, they have 200 plus applicants in their pipeline. But it's not that anyone can come and get a license there. It's not a light touch regime. It is the licensing process. It is in fact quite rigorous and selective by design. So what is interesting here is not the numbers or the number of licenses that they've been able to issue, but it is actually the underlying philosophy, right? Which is different from other jurisdictions. So while most jurisdictions tend to focus on the idea as to how can crypto fit into the existing financial laws or existing legal systems, Dubai asked a different question here. They asked, what if we build a regulator and regulation just for crypto or the other like related aspects of crypto, right? And that philosophy changed everything for Dubai, because they made the regulation activity specific and they made it iterative from the perspective that they'll amend the regulation and evolve the regulation based on new cases such as the FTX case or the Bybit hack perhaps. They are able to evolve the regulatory framework and adjust it to the requirements of the industry, right? So I would say while they might not be winning on scale, fundamentally they have taken a lead or leapfrogged on regulatory design, which is more suitable or palatable for firms to come and test out how they can function within a regulatory environment, right? Now, this approach is fundamentally different from Europe, wherein you have the MiCA, right? Now, the objective of MiCA, from my perspective, and whatever interactions we've had, is to bring clarity, but at scale, right? Because you are interacting with 27 different countries who have to operate under a common regulatory regime. And if you obtain a MiCA license, your license is essentially passported across Europe, right? Serving potentially or theoretically 30 million plus users. Now, while MiCA doesn't focus on reinventing the system like VARA has, right? It does allow for a great amount of standardization across the different regimes who are part of MiCA, right? So when we talk about giving clarity at scale, this is MiCA is a regime which is definitely that one would look at. But the trade-off here is that this standardization has made the regime more rigid and conservative in its approach. Now, this all is a stark contrast to how the United States is going ahead, in my view. And because I closely follow the United States regulation and how the development is happening in this space, I feel the US is the clearest example for the original question that most jurisdictions are looking at. How exactly do you fit crypto in the existing financial or legal space, right? Now, you have securities law, commodities law, you have precedents through enforcement, and all of these converge and shape the market in real time. So I would say in the US, the process, we have not arrived at the entire regulatory framework, but it is still formalizing in nature. And to be fair, all of the US financial regulations have evolved as such, with this kind of synthesis in different sources of law coming together and carving out a space for new areas like stablecoin tokenization, for like general crypto, right? And because the capital and market depth is a lot more compared to Europe or rest of the world in the US, when these rules will settle, in my view, they'll shape the global standards, because the kind of interactions or public discussions that happen in the US market are very different from other jurisdictions, right? So from my perspective, this isn't a race that anyone is winning. And the only way we'll reach at a situation where there is not any regulatory arbitrage, but some sort of convergence between these three philosophies, right? So from my perspective, this isn't a race about one specific jurisdiction, but a race for the entire industry to strike the right balance in terms of which philosophy to be adopted.
Thank you, Harshal. I like the way you approach that, to be more philosophical from a fundamental standpoint rather than country versus country or countries in the EU micro perspective. So I saw Carol hanging on your every word when it came to the U.S. So, Carol, I am going to kick it to you with this question, and I won't ask you to respond to what Harsha said to me. Of course, being with FinCEN.
Oh, I will.
Oh, okay. Well, I wasn't going to ask, but you are most certainly able to do so. So I'll give you the opportunity, and then you can also address this question. How does digital infrastructure intersect with national security interests? So being with FinCEN, right, you are the front line of our fiscal security in the US when it comes to, tokens, cryptos, digital assets. So I know you have a lot of experience with that. So you have the twofold response here. One is the response that you want to give it to what Harshal said, and two, the response to the question. So Carol, the floor is yours.
Thank you. And I appreciate, I'm not known for talking slowly, so I appreciate y'all hanging in with me there. And you're right. Like I loved, like Harshal really teed up a lot of really key and important issues to me, and things that I feel are often sort of misunderstood or not grasped or not really like looked at very clearly on like thinking how policymakers think about what the regulatory approach is. And Harshal really pointed out what some of the benefits are for taking a bespoke tech-specific regulatory framework, which in cases like what Vara did, like provide really like a huge amount of clarity right now. Now, I'll say that generally in the US, we don't like tech-specific regulatory frameworks. We do application-based regulatory frameworks. And that was certainly evident when, like in the last administration, a lot of approaches focused very much on regulation, like the tech and flops and chips and things around AI, and the AI sector was very upset with that, and that manifested in, well, what happened in January of last year. And a mix of a lot of other things that really led to that moment. But it's interesting to see the tensions in the US that have existed on regulatory frameworks that were application-based and tech-specific. At places like FinCEN, and even at the SEC and CFTC, we were focusing on an economic functions-based regulatory approach. So at FinCEN, basically, like since the majority of the use cases that blockchain has supported have been financial, like you are covered for AML purposes. But I'll say that not all blockchain is actually an application neutral technology, right? Like it is a general purpose tech. Unfortunately, I think sometimes for the credibility and the direction of the sector, because the first application at scale that has really been used, and really the main application for blockchain that's been used, has been financial, number go up, like lots of things. Like blockchain has way more utility than, unfortunately, the vast majority of like tokens and projects that involved in this space. I'm very excited about the maturization of use cases that's been happening over the last few years. But basically, I think that's why it kind of works to do a tech-specific regulatory framework in jurisdictions like VARA, at least for now, while most applications are financial. But like I don't think that you should treat something like a picture of a gorilla, or the NFT that someone made of me that was extremely funny, funniest thing I've ever seen. Like a political cartoon about some of the work we did in the White House. And that shouldn't be treated the same as Bitcoin, shouldn't be treated the same economically as a US dollar denominated stablecoin. Those are not functionally economically the same things. They don't carry the same kind of risk and the same kind of impact on consumers or markets. But I also recognize that when this technology that's so innovative and groundbreaking has the potential to basically, like, we're turning instruments into bearer instruments, they can be inherently fractionalized. You can instantaneously understand the value. Basically, the idea that like barter economies can kind of become a thing again, because you can use part of a Picasso to pay for part of a house, or whatever metaphor. I'm terrible at metaphors. Like this really complicates trying to do economic function-based regulatory framework. And like the IRS in the US, actually, like that was a framework that I hated. Like candidly, I really didn't like that we were treating anything blockchain-based the same, because I don't think that security should be treated the same as dollar substitutes should be treated the same as a picture of Carol House. But I also understand the benefit of that is that it's clear. If it's blockchain based, you're covered this way. Now, I know the IRS has worked very hard on like a lot of things that were not necessarily clear and has been trying to clarify some of those challenges. But I mention all this to highlight like the real tensions that I think we're trying to figure out, and how AI is kind of learning a lot of the same lessons and some of these same issues for policymakers trying to figure out, how do I create a framework that is not tech specific so that it's future proofed, but then industry doesn't feel that it's clear enough, like how it really applies to them, because economic function can change by like an individual action and use case. But then if you create something tech specific, then it doesn't last a technological innovation and it no longer is covered there. Like, these are real challenges that jurisdictions still face. And on the national security side, like, this manifests why even like well over 5 years later, when we passed the first international standards at the FATF for AML in crypto, because anti-money laundering and taxes tend to be the first areas that jurisdictions put in place frameworks because of the like illicit finance issues, and then jurisdictions want to get their revenue, right? Like we still have a huge problem on implementation. Like, jurisdictions have not implemented this. Like, North Korea is still using the sector as an open ATM, which no one's happy about, including the crypto sector. No one likes getting robbed. Like, this is in fact a thing that I'm hoping will be a galvanizing, unifying issue for the crypto industry to come together to focus on creating something like the PCI DSS for crypto, but that doesn't exist in crypto, but exists in other payments and high impact sectors. Like, there's massive national security consequences for things that I know compliance is everyone's favorite word. It actually might be for the Blockchain Legal Institute. But when the compliance is to defend against state actors that are coming for you, it's to put in place regulations and critical controls to defend against a generation's worth of wealth that's being harvested through pig butchering scams and ransomware criminals that are shutting down hospitals that no one on this call is happy about. Like, so there still are massive national security implications there. Of course, there's also the competitiveness angle. I am glad that we have a stablecoin regulatory framework in the US, and there's a lot like that we're doing on Genius Act interoperability. I'm kind of wondering if the US approach to interoperability is really everyone else adopts the Genius Act and what our vision is of interoperability. But I'll admit, on the national security side, like I don't know anyone who I think really understands like what is the impact of the fact that now a major holder of US debt is a pretty opaquely governed foreign operating, not GSIB or like central bank. Like, and I'm just saying truly, I don't know. I haven't seen anybody really do that kind of assessment of what are the impacts on markets and the potential for like what happens under stress or crisis, certainly driving up desire for US treasuries, but what happens when the transition for interest in US instruments is for like shorter term treasuries instead of longer term bonds? Like, I don't know. And I think there's other national security issues where like truly issues that people understand individually, but that I don't think they understand together, like agentic commerce, instant liquidity, bearer instruments. Like, we understand each of those things separately. Like, agentic commerce is kind of nascent, but like what these things mean together, like what does that mean for market regulators and financial stability to really internalize what that means for things like leverage and stability? So on the national security side, it's a mix of like there's illicit finance, there's competitiveness, and the US wanting to maintain centrality in the financial system. But like, what does that mean if we forsake indirect regulatory oversight? And then what happens for financial stability in these inherently connected international networks? So I've gone on for too long, but those are like my views of kind of the interconnection of the issues that Harshal teed up and how the US is looking at things.
Thank you, Carol. I didn't get your passion at all in that conversation. So listen, that was fantastic, and you gave us so much more to unpack. You did it from the US perspective. Now I want to actually pivot to a global perspective, right? And we talked about national security and FinCEN, or there's also like, you know, the global versions of FinCEN in various countries. So I'm going to pivot to Bertram and ask these two questions. One is a follow-up to what Carol said. What have you seen global banks like, for example, Santander doing, you know, with FinCEN regulations, or, you know, making sure that the KYC AML is strictly adhered to in those countries? And also, how are you seeing global banks utilizing stable coins for cross-border settlements? Bertram, the floor is yours.
Thank you very much. This is an extremely interesting topic. I mean, maybe I should say that it's my 45th year in the business. I'm an FX veteran since '81. So that's why I have a little bit different view on the things. And also Arise, we have a clear philosophy, but adoption by the banks is very, very slow. because everything is fragmented. Yeah. So even when you talk cross-border payment, I mean, how can you move one stablecoin out of one regulation into another stablecoin or to another country where's another regulation? I mean, these are things, interoperability, cross-border is passporting. I mean, you name it, whatever it is. Yeah. But I think I need to come with a bit of philosophy how Arise we see things. Point one is we are the magnet strip. So we are not the credit card, we are the magnet strip. So for us, where our client is, in which jurisdiction, under which laws or whatever, is really secondary for us because we just provide the infrastructure to licensed entities. So we enable them to do minting, redemption, we audit the reserves and so on and so on. Now I say audit the reserves, that's the next point where we at Arise have a totally different philosophy to, for example, Circle and Tether. We don't believe in pre-minted stablecoins. What is the point? A stablecoin is a tool, is the key to access blockchain technology. So normally what you should do at the moment where you need the key, you create it, and when you don't need it anymore, you burn it. Why have a supply of keys lying around of billions of dollars that nobody's using? Yeah. So we are a big fan of minting on demand and burning when you don't need it anymore. Talking about interoperability, the way when we started to, it goes hand in hand with when you use it and when you need it and you don't need it anymore. But well, what our key thing is when the start is always cash. So if I have cash in my account and I want to use, or my provider wants to use blockchain technology, if I have dollars in cash in my account, let's say a balance of 5,000, or if they are digital, we don't see a difference between fiat and digital. You have a balance in your account. And then whenever you need to do a transfer, let's say $100, and blockchain technology is used for that, you simply on-ramp in the background on our magnet strip. You use this fantastic infrastructure, which is called blockchain. And then when you are done with it, you just burn them again, because then you don't need them anymore, right? So I think that has one big impact, which is one of the key issues we are looking at, and that is anti-money laundering. When you look at the stablecoin landscape at the moment, everything is siloed. The coins are siloed, there are siloed blockchains, there are no existing stablecoin today can be exchanged to another stablecoin without a third party. You need to go to a decentralized exchange, to a swap platform, and I think the big issue is actually the AML part of it. I will not go to Uniswap and exchange some Ethereum to some USDC or USDT or whatever, because I have absolutely no clue where they're coming from. So the whole DeFi world at the moment, for me, is moving around in a kind of unregulated area, but it will, latest at the time you want to off-ramp into a bank account, you will face issues. So I think anonymous wallets, they will simply disappear. It can be privacy ID layers with zero knowledge checks, whatever it is, but I don't believe the industry, or let's say the finance industry and the regulators will accept that in the long term. So why is bank adoption so slow? I think the biggest hurdle is actually infrastructure. There is no real good infrastructure, because it's great. I have a stable coin. I have created my own stable coin, and I have it on, I don't know, on Ethereum. Yeah, but what then? It sits there. It can't talk to any other digital asset. So, and our philosophy is that any real world asset that has a price, a registered price in the market, can be digitized and be exchanged against each other. On our infrastructure, whoever builds a stablecoin, it's automatically 100% compatible with any other asset we build for somebody else, because they're all in the same infrastructure. They're all on the same smart contract DNA. So if I have a provider that has created a dollar stablecoin, and then we have another provider in our ecosystem who has created, let's say, a gold coin, then these two can be exchanged through mint and burn without third parties, no exchanges. I burn my one equity or dollar or asset I have, and of the counter value with an on-chain FX price, that's what we do as well. I know exactly the amount of, let's say, gold on the other side. And then you mint it from fresh. It's not coming from somewhere else. You just freshly mint it on the other side, on the other blockchain, or the same blockchain, just a new smart contract. And I think that this infrastructure is key. I don't think you will ever have a global regulation that's fully aligned. I mean, it's so in the DNA of the different countries how they did their stuff. I mean, they spend years and years to get the financial world regulated. And with Mika, for example, I mean, they just built it on the same. They just try to copy it into the digital world as well. Yeah. So I think there will always be differences, but on the, let's say, transportability of digital assets around the world, and there is already infrastructure solutions to be able to do that. I mean, I had the super example with Jackie the other week when we were talking. If you look at the US, and let's say that every state wants to do their own dollar stablecoin, for example, you cannot have Texas doing a stablecoin and California doing a stablecoin, and they're not compatible. Imagine you need to go to an exchange to be able to pay with your Texas dollars in California. That doesn't make any sense at all. But this problem we already solved today. It takes 3 seconds, and then you are in California from Texas, and you just pay. You wouldn't even notice that it get exchanged, right? So I think infrastructure is a big thing, but I don't think the infrastructure solutions will change regulation. It's not the technical side that will align the regulators. I think everybody has to adjust in the legislation where he is, in the jurisdiction where he is, and make sure that he's obeying the rules. And if I want to do a cross-border payment from the States into Europe, then I have to make sure that I have a regulated stablecoin in the US that I can burn. And when it arrives in Europe, I need to mint a stablecoin that is regulated in the EU. So, and this is actually our main work. This is what we're doing, nothing else from morning to night. So, and it's actually live. So it's not just a project, it works. So finally, I think to see more adoption from the banks, they're all looking for the right infrastructure. You have the 11 banks in Europe now sitting together and trying to figure out how they're going to do it. They need technology. I think in a lot of banks, I think there's a lot of banks out there who are considering to actually offer these services, and they're all looking for technology. I think that's a key point at the moment to really get adoption. On the legal side, they always have legal big departments and compliance departments. I think they know exactly how to do it on that side and which rules to obey, but they simply don't know how to actually execute it and put it into action so they can actually issue stablecoins or whatever. So that's from my side. So we have a bit of a different view. Key point is, and I have to underline that, pre-minting stablecoins for me are CBDCs. What else is the point? For me, Circle is a clear CBDC.
We'll have a conversation about later.
Okay. Sorry. No, that's from my side. So if anybody needs some infrastructure, give me a buzz.
Thank you, Bertram. Appreciate it. Listen, I love this panel because you guys are unpacking so much stuff, and I'm learning something from each one of you. For example, Bertram, I've been in this place since 2017. I never heard of minting on demand before, and burning after you use it. That's so creative. It's such a fresh way of looking at this. But also to tie into to Nick's question, you mentioned that adoption by banks are very slow, right? Now, I'm going to kind of make the assumption that you're talking about large global banks in large, maybe G7 countries. And this is where I'm going to pivot to Nick, where the question for you is, Nick, and again, with that framework in mind from what Bertram said, what lessons can developing markets learn from leapfrogging seen in emerging markets, especially when it comes to traditional financial products, like, for example, in this space, Bitcoin? Because we see emerging markets are doing things a little bit faster, maybe because they don't have the same large infrastructure like banks do to contend with. So, Nick, I turn it over to you.
And that's thanks for that, Eric. And that's it, right? Necessity is the mother of all invention, and we've certainly seen that in the emerging markets, right? We saw in 2007, we saw M-Pesa in Kenya come to market. It found a solution, and to Bertram's point, I think it is the infrastructure is not there. So, but it's coming, and we're seeing that in El Salvador, right? They've kind of just bypassed completely what was provided for practical needs. And when we're seeing this at SAS Mining as well, as we see more broad adoption, we're seeing the Bitcoin come from a speculative asset to more of an everyday utility, and that's certainly something that the developed market can learn from the emerging. And like I said, really, it's an infrastructure. And as we look at what's happening, certainly the beginning of this year, the end of this last year, as agentic commerce increases, people don't even really know that they need this infrastructure for the future that's coming. And I suppose a few other lessons that developing markets can learn from emerging is, and like I mentioned, M-Pesa in Kenya, it's not exclusive, it's very inclusive. It reduces fees. There wasn't the infrastructure in Kenya at the time to facilitate these transactions. What they did have at the time was the relatively new phone network. I think it was done on 3110s, probably aging myself a little bit there, but that's doing transactions on that like that with low fees, no requirement for a bank account, can be done in real time. And really, that's the same as happening now. I mean, I've been to El Salvador and done it there. The infrastructure is right there, and it's very seamless. Commerce is avoiding banks and reducing fees based on that, which is certainly something that I think we can all agree. If we don't work at banks, we'd like to see banking fees reduced. I think one of the great things about SAS Mining is that we're in a position where we've come through the very early adopters who were probably more white paper advocates, and we're now seeing people come and some are at the beginning of their Bitcoin journey, and you can have that opportunity to have a conversation about custody, keeping things in cold storage, and that as cash gets phased out, having the opportunity to have direct transactions is super important for a range of reasons. And look, there's no doubt that, as we saw in Kenya as well, the inclusion of people who probably of the unbanked, with 1.4 billion on Earth, still there's plenty of room for growth there as well. I think another lesson that the developed market can learn, and I alluded to it earlier, is that Bitcoin's coming from a speculative asset a real utility. Obviously, El Salvador again adopting it as a legal tender. It's stabilizing their economy as well. If you look at the inflation rate compared to their and the other Central American countries that are probably on the same sort of development level, sort of excluding Panama, as El Salvador, you've seen lower volatility in relation to inflation and increased uptake in transactions on the blockchain. So really becoming a utility. And I think as in the developed world, we're not seeing it so much adopted straight up as cold storage, but we're certainly now wrapping it in more palatable financial products like ETFs, which not those, but we've seen other companies, treasury companies, offer products that step the risk down. And so it is becoming, in a broader sense, in the broader ecosystem, a non-speculative asset that has real utility in a number of steps, direct to an investment vehicle. And again, SaaS mining, we've got the opportunity to talk to customers and really get an understanding of why they're stacking sats, right? Are they doing it in fiat terms, or do they have a low time preference and that they're just stacking sats for some future that's coming? And with this utility, and look, even the utility of lending against, we're seeing that adoption come from OG Bitcoiners to new miners as well, and really being able to monetize the asset. And even in the States now as well, we've seen the uptake of transactions in El Salvador, but we've now seen the announcement from Block just recently that now the Square merchants all have Lightning Network support. So that gives the opportunity for merchants to use Bitcoin. Another lesson probably be, and Harshal and Carol have spoken at length about it, and that's establishing regulation that is innovation friendly. And we saw, like Harshal said, in the UAE, they've got structure. So with clear sort of guidelines and a sandbox to work in, you can develop different products to suit different markets, and then expand risk more understood, or not. I mean, fingers crossed for Europe. Whereas the US is taking a bit more of a leadership position in this, and with the Genius Act last year, and hopefully the Clarity Act this year, just to get a bit more of an understanding of really where the guardrails are and what products can come from this. I mean, it's clear that the US is wanting to take a leadership position, and it can. We've seen it in Vietnam, we've seen it in El Salvador. It's time for, and like Carol said as well, once the US takes a leadership position, I think Wook said it as well. Once the US takes a leadership position, effectively the developed markets, certainly in the Australia, UK, etc., are going to adapt pretty quickly and adopt those same regulations to really or maybe miss out. So got to get it done. Another lesson would be prioritizing sustainability, right? And see different sovereigns across the world using stranded power, and it's a bit of a misnomer that mining takes up capacity off the grid, where in actual fact it's using stranded assets that are not being monetized in any other way. It's just literally burning energy. And so mining steps in to balance the grid, and that's happening in Bhutan. And increasingly in high cost of capital countries, in the developed markets, you're seeing assets that may have not stacked originally now making sense because there's a cash flow that's definitely going to come from Bitcoin. Regardless of the price on the day, there's certainly sats that are going to flow from that, and it balances the grid, right? You can flick it off and on at the flick of a switch, and it also provides the opportunity to on particularly renewables assets which may have sort of reached the end of their depreciable life but still have an active life that can be continued on to from a green perspective and not waste those assets. And for example, we're looking, all of our data centers across the world use 100% carbon-free energy as well. And there's certainly places even in the US that we're starting to see in Texas even that are starting to see projects come to monetization because of having Bitcoin mining be able to monetize, particularly the initial part of the build and the assets life. And then final lesson is building resiliency, and we've seen that, like I said earlier, El Salvador's seen inflation below 1% compared to its neighbors who've got higher volatility. Argentina knows a little bit about inflation, unfortunately, over the course of their history, and you've seen a large uptake in adoption of Bitcoin for exactly that. And I think developed markets think sometimes that it can't happen here, but certainly in the US, we did see it happen here, and people are switching to see that Bitcoin is an inflation hedge, albeit relatively volatile. But there are, again, different financial assets that are coming to market to step down that volatility to fit in any sort of tranche of a balanced portfolio. I think that's predominantly the lessons that can be learned. But lots of lessons from emerging.
We've had a very full panel, and I want to step in to thank Eric for being our moderator today, and everyone who's been on the panel. I know that, Matt, I'm going to let you kind of share a short message before we hop on to our next panel.
Sure.
Jackie, can I guys ask them one question each?
No, unfortunately, we do not have time, and nope. I'm going to have to be a timekeeper on this. Every one of our panelists will always have the opportunity to do a full 30-minute talk show with us, but we do not have time because we're already 15 minutes past on our panel. So
that's cool. Yeah. So let's wrap this up. And in case you couldn't tell or didn't know, Jackie's also a school teacher.
Now you're on mute.
Not just a partner at Cogent Law, right? You're also a school teacher, so that's why she keeps it pretty strict. So we're coming, live here, and I appreciate everyone for being a part of this live show. Very unique the way we do it. We probably have representation from 5 or 6 continents, and no matter where you are listening from, nothing that you're hearing is legal advice or financial advice. These are all just really good insights from the people that are part of the Blockchain Legal Institute. So having said that, I think we need to clear the folks out of here. We probably have a quick commercial, and then we've got another panel coming up, and that's specifically why we have to stay on track here. We probably have another 15 people coming up, but big thanks to everyone who was a part of this one.
Thank you, everyone.
Thank you.
Welcome to a new era of digital assets. Freer, safer, and within your reach. Send and receive with ease, even with just an email. Simple, fast, and seamless. Stay connected to what matters. Access your favorite social media, shopping, news, and more, all in Life Wallet. Your assets, your control, protected with powerful security you can trust. Life Wallet, connecting your digital assets and bringing a new experience into your hands. Download the app today on the App Store.
Wow, those rock and roll tracks really keep the energy up. I like that. What our partners there at Rio are bringing. So we have another panel coming in here. I think, Jackie, you're participating in this panel potentially.
I'm actually going to be moderating because Magnus actually, like with everything that's live, his flight got rescheduled. So we were learning about this in our green room, and like everything else, we go with the flow. So we will definitely have Magnus on a talk show, so that way everyone can learn more about his phenomenal background. So today, this panel is actually, for me, an area that I am learning about. And so those that we've invited to be on are experts in this area of DeFi treasury management and the opportunities and risks for institutions. Because again, when you're thinking about traditional finance and, there's certain rules that have been in place for many years. And when you then talk about decentralized finance and how it's changed, there's a certain thing that now the traditional world is looking at. So I'm going to ask each of you to do an introduction of yourselves, and then I'm going to be speaking with each of you on a certain question. I know that with who's on the panel right now, we will be able to keep on time, so that way we can have the follow-up panels also be on time. But we have Dr. Beck, we have Bern Bennett, Wesley Crook, Hiroshi. We have everyone on from all around the world. So why don't you, we'll start with Dr. Beck to introduce himself, and we'll kind of go from there.
Thanks a lot, Jackie, and thank you for having me. It's a great panel. It's a great event. I'm a professor at Bentley University. I'm running the Crypto Ledger Lab here in the Boston area. Before that, I was the head of the European Blockchain Center. I was in part of the European Blockchain Regulatory Sandbox. I was representing Denmark when I was working in Copenhagen in Denmark at OECD, UNECE, ISO. I wrote the blockchain governance standard. I wrote the ethical guidelines for blockchain systems, etc. So I'm taking the research hat here today, and I'm happy to be here, and I'm looking forward to the panel.
Yeah. Wesley, why don't you go next?
Yeah, thank you, Jackie. I'm Wes Crook. I am the CEO of FP Block. We are a long-term engineering firm that's built enterprise and has been building enterprise-grade systems within the financial system since 2012.
Bern, why don't you go next?
Thank you very much, Jackie, and thank you for having us here and all the hard work that's gone into this event. I am Bryn from Hacken. I'm the head of business strategy. We are a global cybersecurity provider for the blockchain and digital assets industry. We've been in business for 8 years, serving regulators, institutions, enterprises coming into the space and building on top of blockchains.
And Hiroshi, why don't you go next?
Hi, my name is Hiroshi Uehara, representative director of CoinHub, a licensed exchange in Japan. Thank you.
So we have such a variety of individuals who are on the panel, both from technologists to those that are running businesses. And so the questions are going to actually cover all of that. So the first question, actually, I'm going to direct to Wes, actually. You have been in this area, this business for a while, and your business looks at how do you prevent risks. So can you share cautionary tales that have that you've seen that have changed how you approach DeFi liquidity and how you've approached companies that you're supporting in the space?
Yeah, I mean, I was thinking about this question, in the pre. I think the one that really stood out to me was back, it's been a few years, but when Silicon Valley Bank went under and USDC depegged. Everybody thought USDC was just like $1, but we found out a few things that were kind of not. When the bank went down over the weekend, we had a liquidity crisis. We had a depegging of the USDC that created, some panic. Which put it, I think it drove down 85, 90 cents or something like that before it recovered. But I think it caused treasuries, and it caused, a lot of people to think about what is the value in compared to a fiat currency and all. From a treasury standpoint, you had to start scaling and haircutting
the value of this, because people thought of stable coins as independent instruments, and they really weren't. They were correlated, very correlated actually, because everybody was running for the next thing, either back over to Ethereum or back over to Bitcoin, and all the liquidity pools got imbalanced and dried up, and all of a sudden treasuries were stuck taking haircuts on their positions. And from a treasury management strategy and a treasury risk profile, you can't have that. Treasury is supposed to be very, very predictive, very, very risk averse, because you're dealing with corporate funds. So I think that's the biggest one that kind of is a cautionary tale, because everybody was running around back there. We had the Terra Luna crash as well. We had a lot of depegging going on, and people started realizing, within the industry that, these stable coins weren't so stable in certain stress environments, and certain things. So from an engineering perspective, when we look at building for our clients, understanding what they're trying to do with their technology and what they're actually trying to do with their business, it being a RWA, be it a trading platform, being in a whatever it is, with a DeFi or TradeFi type system, making sure they understand that liquidity is king. And having a balanced liquidity pool and having a secondary and a tertiary liquidity pool is very key to keeping balance and order with whatever you're doing. So, it's really more around, not living so far out on the edge that a lot of people do in this space. And we're starting to see, we're seeing the TradeFi and we're seeing the treasuries of corporates coming into this space, wanting to tap the liquidity and how to play in this space. But there are some serious rules that, they're just non-starters for these folks as far as, accessibility, security, risk appetites, who's on the chains with you, not being on the chain at all, being private. And also recognizing too that, the weakest link is not necessarily on chain, it might be off chain. So, understanding all those things with your customer or with our clients when we build for them is to make sure they understand the whole picture. It's like, yeah, great, we can go build you a high frequency trading platform and you can go have fun all day long. But if you're not planning for all these things, you're not going to get, you're not going to have good treasury management, and you could go up and smoke in a matter of days or hours. And we saw that back in the, 22, 23 timeframe. So that's kind of what I kind of see out there, and what we've, lessons learned, so to speak, that we try to embark on our customers when we start building these things for them.
I think that we've seen with these various panels is that there's many layers to this financial trajectory. You have the products, and then you have the institutions, and then you have to figure out how are you managing everything, and then how do you offload it, to the consumers or the businesses. Roman, I'm going to go back over to you. What are the biggest technical friction points that you, from your being in this space for many years, both over in Europe as well as the United States, when integrating DeFi with traditional reporting? I know you've taken a look at this from both sides of the ocean, so to speak.
Yes, thank you, Jackie. It's interesting how quickly we are ending up always discussing stable coins. Actually the field should be much broader, but it's the S word. We are coming quickly to the S word, when we talk about TradFi and DeFi. And allow me to say a few more words on that one as well, because that was my previous speaker was kicking it off. When, I'm really wondering why this is called stable coin. And it's a bit of a misleading term, because actually it is not that stable. We have seen that Tether was 99 cents on the dollar. We have seen that chains are offline, for 60 minutes. We are seeing that wallets are frozen. We are seeing that USDC, USDT is enveloped and traded on other chains. And that is actually something that is pretty much concerning me, because to your point, to your question, Jackie, when we're talking about accountability, we are mixing up transparency with accountability. And the moment you're opening interoperability and you have the chance to transfer tokens and re-rep them and trade them on other chains, the whole idea of accountability is actually out of the window. And that is what traditional finance, traditional players are concerned about. If you are actually Basel III compliant, or you're trying to stay Basel III compliant, you have a hard time to figure out how technical risk management, operational risk management, financial risk management conveys over into parts of your business, of your operations, if they are sourced or built upon a more or less distributed network, stablecoin, digital assets, name it. And that is the main hindering reason for most companies. I just recently had a conversation with a large German technology provider, and that company said, we don't want to have a wallet. Of course, we have a wallet in El Salvador because it's mandatory, but otherwise we don't want to have a wallet, because we cannot really kind of put into our accounting system, for example, the date when we are putting down something into our records. What does that mean if something is traded and wrapped and executed elsewhere? How is that reflected in our good old bookkeeping system? I mean, and these questions, as mundane as they may sound, are very fundamental and very important. And as long as we don't have fixed them and we talk about Genius Act and what not, right, it comes down to kind of bookkeeping practices. What is an event? How do we actually assure that that smart contract, that wallet, that entity behind the wallet, we can tie this to a legal entity and we can put it on record? That is very basic, and of course, a lot of companies are working on that, but we are not there yet. And that is one of the main reasons, why we are seeing quite a reluctance of companies on both sides of the pond, kind of moving forward and being more serious about blockchain and cryptocurrencies and, yes, stablecoins.
So I'm going to open it up to the whole panel. Any comments on what Roman was talking about? Because again, we do have some time for panel discussion as well. Bryn, would you like to comment on this? If you can unmute.
Yeah, fantastic. Yeah, I think I have some preparations made for the question that was dedicated to me, but maybe I could just cover that now. So we see a 6-pillar framework to understanding risk in crypto and in digital asset markets, and this is one of the services that we provide to asset allocators or insurers or treasury managers and these kind of folks coming into the space. So the first one would be technical integrity. I think Roman touched on this, but we're looking at the smart contract and protocol level here. So for example, as Wesley mentioned, the depegging incidents, exploit patterns, things like TVL draining, and also we'd be looking at smart contract audit relevancy there as well. So there is a phenomenon where blockchain projects will have their smart contracts audited by a professional cybersecurity company, but then they will often upgrade the contract over time and they will not get another assessment done. So this is one of the things we look at there. The second area is economic solvency. So we would be looking at things like liquidity changes inside contracts and pools. We will be looking at shocks like the USDC incident, gas prices and spikes in those, and irregular fund flows, really trying to catch anything that indicates financial stress or manipulations. The third area would be regulatory and sanctions risks. So looking for wallets and addresses that are on sanctions lists or are can be connected to sanctioned addresses, anyone that's been involved in a cybercrime or a hack, and clusters of suspicious addresses. So one of the things that often happens after a crypto hack is that the funds will be split into multiple wallets, hundreds or even thousands of wallets. And then the hackers will try to launder the money through various different services that allow them to hide their identity. And I just learned actually from a lovely lawyer in the UK called Matt Green that this is called smurfing, this phenomenon, just yesterday. Okay, so that, and then the fourth pillar would be market sentiment. So we're looking at, for example, sentiment analysis on X. We're looking for chatter around hacks and scams that have happened, threat intel reports from other people in the space, in the security space, and sentiment around the team and the community and the founders of these projects. Fifth one, we will be looking at operational security. So who has access to administrator permissions, who has access to multi-sigs, which are wallets with multiple signers, so often used for the treasuries of companies in the space. We're looking at infrastructure vulnerabilities, so have any server-side exploits happened. Front-end compromise, this happened to a major DeFi protocol for the second time over the last week. And then the sixth and final pillar would be governance liabilities. So is there any risk from centralized or abnormal control actions? We're looking at governance concentration there. We're looking at deviations from the agreed governance patterns, and also proposal integrity and anomalies in voting patterns as well. So we have codified this into a framework, and ready to help any companies that are serious about analyzing risk in the sector.
So I know that Hacken has been around for a while. When did it actually get started?
Hacken was started 8 years ago, and in Ukraine, it started as a bug bounty platform. So, and Hacken Proof today is the biggest bug bounty platform in Web3 and one of the biggest in Web2.
Yeah. So definitely speaking from experience, just like with Wes and his company, speaking from experience, and obviously Roman from everything that you've done here, share more about CoinHub and what you've have experienced. I know that the question that I wanted you to talk about was, as crypto grows everywhere, how do everyday spots like ATMs and apps help money flow between normal banks and blockchain? There's a lot of cross application that's going on now. And it's becoming more everyday for the consumers to be able to work within this area, but there's still some friction. So why don't you share?
Yes, thank you. Well, I agree with this panel, which is stable is nothing stable really. USDT, USDC, 70-80%. It's really 70-80%. Only 70-80%. They on the contract. If you read all the contract, not only it's only a guarantee, only 70-80%, but not always. Sometimes it goes off. Sometimes it guarantees zero. So stablecoin, it's been recently, I think, because of the Genius Act, Stablecoin Act. There a huge spike by trust banks to issue stable coins on their own currencies, whatever the country they're from. They just want to issue their own stable coin backed by their own currency, and request a lot of inquiries to put that stable coin on our ATM network. However, there's lots of risks right now, and the biggest risk I hear from these banks that once you issue stablecoin, you can't go back. It's really not easy to go back. So I think the the first panel, I hear use case. That I think that's the most important. A lot of banks right now are jumping onto stable coin, but if there's no use case, there's no use. You're wasting your money. So that's just my comment on the stable coin. And this question, yes, ATMs. I get to ATM part, but I just like to address some apps and debit cards, which is debit cards are very, very popular right now. Crypto debit card is very popular. Well, there's a big problem when you think about the flow between normal banks and blockchain. There's a big problem. My opinion. I'm sorry. I'm just gonna express my opinion here. The banking system is running on the rails of ACH, SWIFT, and SEPA. And this system is completely different from blockchain. Mm-hmm. Blockchain is run entirely separate infrastructures. And one good example I can mention here. I like to mention from my personal experience. There is this bank that I spoke with. They operate 35,000 ATMs, and this is a big bank. And they said that their system is basically just a point system. There is no way for bank ATM to integrate blockchain in their system. So although it looks like there's a flow between normal bank and blockchain, it's really not. And because of the Genius Act and the Stablecoin Act, and because every bank is looking into stablecoin, they are just converting their internal point system into blockchain. In other words, it's just a bank, regular banking. But blockchain is at its core just a code.
Mm-hmm.
And banking institution is a business. It's a money making business, or money breeding money kind of business. So blockchain doesn't think, it just exists. But the banks, they think they need to make $770 million a year, the top of the bank, I mean. For example, JP Morgan Chase. So these banks need to make money. And so to me, right now, what's going on right now is really not happening. It looks like it's happening, but it's really banking institution taking over the concept of blockchain, addressing it look like it's merging, but it's really, for example, those debit cards, the crypto debit card is on the rise, but you still have to deal with the bank. You still have to open up a bank account. You have to fund it, and you have to, within the institution, you have to open up an exchange account, the crypto account, and so on and forth. So you are still operating inside of the banking system. So that's different. However, though, I do think there is still a good future to come. And I often refer to the system, a crypto ATM system. The pure crypto ATM system can skip the bank completely. You can bring your cash, stick into the machine, and the machine will tie your cash to blockchain direct. And if you so prefer, you can get the paper wallet with secret key on it, that only you have it, and vice versa. You can cash it, deal with the blockchain direct with the cash. So that's where I think the crypto ATM has some bright future. Just my opinion. I seen half of the year I live in Las Vegas, and every gas station I go, I live suburb of Las Vegas. Every gas station I stop has at least 2 or 3 crypto ATMs. There, according to MIT, there are 60,000 crypto ATMs in USA. So there's something there that people are catching on, and that is crypto and DeFi are beginning to challenge the banking monopoly on money. I think that's still to happen. It didn't happen yet, but it would come in near future, and I hope it will come in near future. But sorry, I tend to talk long, so I stopped talking here.
It's all good. It's all good. I'm going to do a lightning round for everyone. If you had 30 seconds, and if you were to predict within the DeFi treasury management area, a change or an update that you see happening within the next year or two, what do you think that would be? You know, from the perspective of either legislation that's going to be happening or areas that the institutions are going to adopt. I'm going to start with Brent.
Nice, thank you. I was itching to jump in here. I think I will mention a continuation. I think Hiroshi touched on a really interesting point there about older token frameworks and older stable coins. It's very difficult to upgrade them if they don't have the upgrade flagged inside the smart contract. So I think that's why we see a lot of banks and institutions launching their own blockchains or launching, issuing their own tokens, because they need to have more modern tooling. It's actually a conversation I was having with the Chainlink team about their ACE engine just this week. So that sits inside a smart contract and programs the compliance policy and maintains the compliance policy inside the smart contract. But because older smart contracts don't have this upgrade feature, they can't have access to this latest and greatest tooling. We have to build like wallet frameworks around that or other frameworks around that. So I think probably I will say a continuation of this trend of banks launching their chains and launching their token projects as well is going to continue.
Roman, what do you see happening besides the modernization like that?
Thanks. I think kind of people will figure out in the next 12 months that walled gardens, branded chains, and so-called distributed blockchains or banks running their own blockchain are the same old. We are back to square one, where we started from. And I was at a policy week last week in Sydney, and people were talking about, we have to abandon the term blockchain, and we shouldn't talk about decentralization any longer. And we are living in dangerous times, to be honest, because people think they can harvest the benefits of blockchain while abandoning its roots, right? And what we're seeing is we have Tradfi models that are wrapped in DeFi garments, right? And we will, we mentioned already some examples where people learned the hard way that a dollar isn't a dollar. Right? It's a highly complex financial instrument, and a lot of people and a lot of organizations wash their hands in the making of that. It's like sausage making. So, and that is the problem. We are back to actually an opaque system, and if you think about the white paper, Nakamoto, transparent, easy to understand, structured, decentralized, all the financial instruments that are so complex and there's so many people and companies involved in that even experts have a hard time to figure out what's going on. We are back to square one. We don't have to blame Swift, running a black box. We are running a black box. And I think in the next 12 months, back to your question, Jackie, more and more institutions, more and more investors will figure out we are not closer to the solution yet, because we are creating new intermediaries, we are creating new choke points, and that needs to stop.
Understood. Wes, your 30 seconds.
Oh, yeah, thank you. I agree with the professor and Brian. I think what we're going to see from an engineering technology standpoint, and I've said this many times, is we're moving to one single infrastructure. Even though we have a DeFi blockchain environment, we're going to move toward one blockchain set of rules, one standard system. It still will be blockchain. It'll still be a distributed ledger type system, but you won't have the Ethereum, Solana's, pick one down the world. Will come to a common rail that we'll live off of. I think that's coming. I don't think it'll be in the next year, but it's going to be in the next couple of years. You're already seeing a lot of chains kind of fade out and fall off as we move forward here. Obviously, Ethereum and Solana are the two primaries right now that everybody hops to. But I think also, it is very much two different systems, the standard traditional banking world and the blockchain world, the DeFi world. There's still a lot of discrepancies there. You're hearing people, we're talking to folks about building middleware, basically old system architecture where, you have these enterprise systems that don't talk to each other. So you're building these black box mousetraps in the middle to sync up things. And, the data integrity issues, the data synchronization issues are huge in this space that have to be, dealt with. The speed of transaction has to be dealt with, depending on chain that you're running on versus, the physics problem with a lot of TradeFi or trading systems where you're next to the data center and you're just speed of light, you're only slowing you down. Whereas on a blockchain, it could be 4, 5, 6, 7 seconds before something gets moving. So for financial instruments, that's not acceptable. So I think you'll see over the next 12 months, to your question, continued consolidation, continued regulatory clarity coming on how we look at the way we handle this stuff. I think you're going to see companies like American Express, Visa, MasterCard under great pressure with the fees they charge on their cards, and the banking, where they're making their money is under pressure with stablecoin and blockchain technologies, because we have cross-border payment, we have cross-border basically currency that we don't have to arbitrage, we don't have to do anything like that. So there's going to be a lot of pressure playing out over the next 12 months. And I think you'll start seeing, as we came into this year, we'll see more clarity and more regulatory policies being put out that'll help us get to the next step. But I still think we're 2, 3, 4 steps out before we actually see a blended world of standardized banking and DeFi. But we're working our way there slowly.
Thank you. Hero, 20 seconds, 30 seconds.
Yeah, I'll make it short. Yeah, I have no idea what's going to happen in the future. I don't predict the future. However, this is my hope that in next 12 months, there's going to be a stable coin with tremendous use case. And this stable coin doesn't have to make $14 trillion like BlackRock does. So, and this is just pure system, no exploitation, tremendous use case. That stable coin is about to come out. That's my hope.
Appreciate everyone who's on this panel. And as you know, we are about to go into our 4th panel, which is dealing with ConsumerFi. So we are going to have you exit. We're going to watch another short little clip, and we appreciate everyone who's been here, and we will see you soon. All right, everyone.
Thanks, everyone.
Web3 innovation is revolutionizing global grain trade. Today, farmers may wait weeks or months to receive payment from grain shipments. Paperwork, banks, intermediaries, and outdated verification methods cause major delays. RioPay and GrainX Global are transforming the entire process. Using RioPay, once grain delivery is confirmed, settlement is instant with much lower fees. This means faster cash flow for farmers and a much more efficient grain supply chain for everyone.
Now I went into the
Find out more on riocoin.com.
Let me try to get back into the other room.
We're back, everybody.
We're back, and we can hear everyone. So welcome. So Anthony, you are the moderator for this panel. We welcome you, and we will let you take the mic.
I can't hear Jackie.
You can't hear me.
Is your mic off?
Anthony, she was just handing it over to you, brother. You're the moderator.
I'm sorry, I couldn't hear Jackie. She was for some reason my speaker wasn't working.
That's fine.
Well, hello to everyone. We're speaking from Japan. It's currently 4:40 a.m. here, so you guys are all lucky. I've been up all night, so you got to bear with me. I'm really excited. I listened to all the panels and just the development from the last. It's hard to believe that we were on this, Jackie, just October, and it's already here. And then a year ago, we were on the first one that we attended, and things are just moving so fast, and the development that's happening in that space between the summits are astronomical as far as how the global blockchain space is moving. So this panel, I'm glad that Jackie chose me for this panel, because this is where our main target with RioCoin and our project here in Japan is for consumers. A lot of people are always talking about, blockchain this, blockchain that, but they never bring it down to a real use case for like grandma and grandpa. And that's what we've done in Japan. We've dialed everything back. We don't talk about blockchain, and we just show that our system is another payment system. The rail just happens to be a blockchain, but the front end is very user friendly, and the UI and all our apps are very friendly to the users. And that's why I'm very passionate about what we're going to discuss. Now, let's go around the room and introduce each other and your background. So let's start with David.
David Pope. I'm a certified public accountant.
David.
Oh, it says my mic is working. Can anybody hear me?
We can hear you. We can hear you.
Loud and clear. There.
Awesome. David Pope. I'm a certified public accountant, global management accountant, and I've been an accountant for 39 years, and I've had my own firm for 30 years. I got started in the blockchain world in 2017 when I sat down and mapped out a supply chain use case and saw what absolute power this technology was going to have. And I helped form the Wyoming Blockchain Coalition. And we have been successful in getting probably close to 45 to 50 statutes passed within the state of Wyoming between then and now. One of the most significant, or two of the most significant, have been the Special Purpose Depository Institution, Speedy Banks,
give me a phone so I can listen
which
to
Kraken, it was the first one to get a charter under that statute, and then they are now the first one to actually open their doors and do business and get a Fed master account. The second most important one, I think, is the Wyoming Stable Token Act, which Hero was talking earlier on at the end of the last panel about wanting to see a stable token or a stable coin use case that was for public good and for the consumer, and that's what the Wyoming Stable Token is. It was launched on January 7th of this year, and it is slowly ramping up in popularity. The token is issued by the state of Wyoming with assets kept in trust at a 1. And it is slowly ramping up in popularity. The token is issued by the state of Wyoming.
Sorry, there's a
with
really annoying
assets kept in trust.
Anthony, could you mute?
The token is issued by the state of Wyoming.
Anthony, brother, I think you got some technical issues going on over there.
So Anthony, you're going to have to.
Can you guys hear me okay?
Yeah, we can hear you fine. You just can't have two things on, because then we're going to have a double conversation going on during the conversation.
Well, as much as I like to hear myself talk, that's not something that is probably a good listening experience. As much as I like to hear myself talk, we launched on January 7th. All proceeds that are generated above and beyond 102% of the asset base they go back to the Wyoming School Foundation. And the School Foundation is what pays for all school infrastructure within the state. So that dream of seeing a public infrastructure or an infrastructure that is for the public good, we have tried very hard to develop within the state of Wyoming, and I think it's going to be one of the biggest stable tokens on the market soon.
Thank you so much for sharing background. While I don't know if Anthony is muted or unmuted, Tanya, why don't you share your background while we wait for him to kind of think.
Okay. I don't know if Anthony is muted or unmuted.
Go ahead, Tanya.
Wait for him to kind of.
Here we go. Okay, so my name's Tanya Seda. I have been around the technology financial world for 30 plus years. I am a retired epidemiologist who stumbled into this field, so very interesting from that regard. But essentially, I've been doing forensic audits, network design and a lot of other things for big telco companies, data centers, and I get brought in to audit about every single type of customer from mid-market, enterprise to the Fortune 500s. And as I'm doing this kind of work and being brought in to do root cause analysis, I am approaching what you guys are doing from the opposite. So you guys are doing like the sexy stuff, trying to figure out all the cool new things that are going to happen. I, like I've always done, am on the back end doing the unsexy work. For instance, they, for years, used to say, oh, I get what you're doing. You're the Merry Maids of telecom. And I'm like, all right, yeah. So what I did through all these years, I was deciding, should I retire or am I going to fix these industry problems we're having? So basically, I created, and it's patent pending, TimTrace, which is basically a next generation model for enterprise operations, and it unifies Web 2 systems, and it secures outputs via Web 3 consensus technologies, which is very different than most people are used to. And enterprises today are crippled by fragmented workflows, inconsistent data, and manual workflow processes. So these efficiencies, from what I've seen, you know, they result in operation loss, payment disputes, compliance failures. I work a lot with compliance and regulatory departments, and high audit burdens. So what I've been able to do is build this system that notarizes everything up front, anchors it to the blockchain, creates a chain of custody recordship at your fingertips, and it wipes out 80 to 90% of audit work and manual labor from trying to put together contracts, invoices, all that good stuff. Where this leads into is that I built in the system an IT HR AI agent workflow. So every AI agent or robot that's going to come into the system, like old expense management, I can manage all those assets like a person. So that's the really cool next thing that I'm able to do. And most of my conversations right now are about, you know, I just spun, like McKinsey just spun up 50,000 AI agents, right? No one's watching the back end. No one knows how much, where they are, who assigned them, what cost center, what GL code they align with, and how much they cost. And my platform fixes all of that. So I'm very excited. And thank you.
Yeah, yeah. So we have Jacob. Why don't you go next and share a little bit about your background? Are you able to unmute?
I think Jacob might be frozen. We've got epic tech problems.
All right, we're gonna go with Justin.
Yeah. Hey, everyone. Nice to meet you. My name is Justin, and I currently work at Sum. My background is I started at Ernst & Young. I'm also a CPA. I was doing financial audits. So, Tanya, a lot of what you were saying actually resonates quite a bit. But then I moved into crypto tax prep for a while. And so worked across a bunch of these different tax softwares. All of them are riddled with problems. Some are great, some are bad. None of them are perfect. That's really how it is. And so took that experience, and then now the product and go-to-market lead at Sum, which is formerly Crypto Tax Calculator. And so helping build this product to account for all these new regulations. I mean, every single day, it seems like something new is coming out. I mean, even just yesterday, Notice 2026-20, extending the relief for, your broker or being able to provide your own cost basis on your 8949. So there's a lot that's changing. And as we know, in the US, we tend to lead with regulation, and then the rest of the world kind of follows. So we're anticipating as we progress towards this, regulating crypto tax and, making sure that there's a lot more visibility, the rest of the world is going to follow as well. We see CARF in the works as well. And so in this day and age, as it relates to consumers, one of the most important things is, at the end of the day, you can have all this cool tech, but if you don't have the ability to accurately report it in an easy way, that's going to be a full stop blocker. And so on the consumer side, that's the problem that we're working to solve.
Everyone here is dealing with a different element of the consumer area. And I know that as soon as Anthony can come on, he will, but I'm going to start the questions. So David, you started speaking about the stable token. And so how is that setting a blueprint for consumer grade savings and other opportunities to kind of navigate this new financial market, or maybe not new anymore?
Well, certainly not new, but still largely unadopted. When I look at that, one of the reasons I moved into the blockchain space and began working on the policy side was because in addition to what it would do for us accountants, Justin will have an opinion on that, I'm sure too, but also when you look across the world, roughly 25% of the people around the world do not have a bank account, and that translates also to about I think the last statistic I saw was 5.6 million people in the United States don't have bank accounts. There are lots of reasons for this. One of them is that they have done something in their past and their credit will not allow them to have a bank account. A lot of younger people have never ever had a bank account and have grown up with things like PayPal and Venmo and companies like that, but without a bank account and without some way of accruing value in your financial world, you can't accrue that value. You can't in a modern world, especially with the IRS that requires everything now and moving even more to requiring everything be done electronically, you can't exist, at least in a profitable way. What stable tokens do is they provide that opportunity without a bank. And I know there are bankers on here that will not like what I'm saying, but and it's certainly not all their fault that there are unbanked people. The regulatory structure in the United States forces them to eliminate a certain part of the population from their customer base, and that's something they can't control. But second on that issue is that with the stable token, with our stable token, what we designed it to do was to be a platform, basically. You look at the iPhone back in 2007 when it first came out. It was not the fact that it was a great phone, which in many instances it wasn't a great phone when it first came out. I remember the dropped calls and all of that, depending on how you were holding the device. But what it was a platform for applications that had never truly existed before, that then consumers and developers could come and create this wonderful world that we see now on our phones. The stable token is a little bit like that, except that it is confined to payments. However, there are companies out there right now that are beginning to develop applications like you look at cattle pay, and cattle proof. What they are doing is developing an entire blockchain experience, including developing the use of the stable token as the payment system within that universe. You look at a number of other companies that are really looking to the structure of the Wyoming stable token in order to develop out their payment systems within their apps because of the fact that we are statutorily required to maintain that 100 to 102% backing at all times. So we've set the stage for literally a world without a world that can be transacted without using a bank, and that will rope in the consumers that are unbanked. Then beyond that, you look at cross-border remittances, institutional applications, merchant and business adoption. We had one of our county assessors that spoke at one of the Stable Token Commission meetings about the cost to the citizens of paying their property taxes via a credit card. And what we can do is we can accomplish greater speed, greater accuracy, and greater efficiency through blockchain and the stable token. So that's where the consumer grade savings and financial use comes in, is the fact that everything can happen quicker, everything can happen better, more accurately, and in the case of a government entity, with a lot more transparency. So that's the basic view of the financial side of why what we are doing works.
No, that's phenomenal. And Anthony, welcome back. I know that whenever we have a live show, there's always tech challenges. And so we welcome you back. David actually kind of contributed on his side. It looks like Jacob is now also with us as well. Anthony, who would you like to ask the next question to?
Yeah, I'd like to ask Jacob. This is kind of like the holy grail that everyone's trying to solve, which is how do we balance decentralization with the need for robust consumer protection?
Yeah, I think it's extremely interesting topic. And first of all, maybe just to introduce myself a little bit, 10 plus year background, initially as an auditor, and now CEO of Nordic Blockchain Association, which is the largest blockchain association in Northern Europe. So that means we have a lot of members, everyone the Nordic to as well to global players. We operate in 3 different verticals. One of them is events and meetups, roundtables. So we do a lot of activities like these things to connect and unite. Then we do a lot of data reports, consumer behavior, stablecoin adoption, company uses of blockchain, and then we do a lot of working groups with our members where we do public-private initiative. And I think right now for me, it maybe take a step back and say, okay, right now we've got the stablecoin, so everyone is talking about financial within blockchain. And I think the way that at least that I'm personally looking at it is saying it's decentralization of data. So money is one thing, identity is another thing, digital wallet is another thing, right? So I think it's more how can you push the security layer closer to the consumer. Right now, a lot of the security been on-chain in smart contract or a little bit more on protocol level. But if you're going towards more consumers, it needs to be extremely easy. So that means the interface for consumers need to be extremely easy, and you need to think about these different security matters. Still seed phrases and it's still too complicated. So I think it's basically moving the security layer up to the consumer. And then that would obviously, at least for me, be the question, like what are the user actually going to use it for? Financial transaction is one thing. Other thing is identity. Other thing is data in general. So I think it's moving it up closer to the consumer, and then really have like a discussion on what is actually needed in regards of consumer protection, which of course is a large thing in our region. And I think it is globally, but for us, there's quite big trust in the financial system and government. So the uses of blockchain from a financial infrastructure perspective is not that developed as it should be. So we're really focusing a lot on what can this actually do in regards of GDPR and consumer protection. So I think the initial one would be like it needs to be closer to the consumer end user, and it needs to be a lot easier.
Yeah, here in Japan, it's kind of a delicate balance because, we're always talking about DeFi, but then you're having to deal with the FSA, the regulators who are very centralized, and trying to maybe how do I frame this without sounding like I'm talking down at them? They're not. You're almost having to educate them a little bit on how the blockchain space is moving, how consumers are gravitating towards this. But that's the choke point over there, and trying to blend that. That's what we've been doing for all these years, is trying to let them understand, the regulators understand that this is what's happening in the market, this is what's happening in America and in the different countries, and why we need to have that delicate balance here. So I want to talk to you further, Jacob, on that, and see what you guys are doing over there in Europe, and see if we can if it aligns with what we're attempting to do here in Japan.
For sure, I think from a high level perspective, what's been going on, especially in the States, now people realize what stablecoin is from a, let's say, geopolitical point of view. They understand that 99.7% of all stablecoin is USD backed. That means that the banks and the financial institution now need to do something, right? So they've been launching stablecoin consortiums. Maybe heard of Cavalis out of Holland. Started out 9 banks, now 12 banks, and that's really moving ahead. So I think that people now understand that the digital economy would be using stablecoin, right? Next step is like they now understand that AI agent, as you mentioned, they need money, right? Robot money. That's probably going to be stablecoin. So I think there's like a revival in Europe, at least in Northern Europe. But it's like a diligence balance, because there's still a lot of talk about bad actors, speculation. So right now there's election on Tuesday in Denmark, and we perform a crypto list. So basically mapped all public elected and opinion towards it. And the issue is that people don't really get it. Like most people, it's just like, this is scam, because they've heard so many bad things, and other ones like really understand this is financial infrastructure. So I think we're seeing a tide changing here in Europe, but at least for us, we really try to talk about, like, besides the financial infrastructure, what can it actually do, right? And in Europe, we got the digital wallet come up, we got digital identity, we got digital product passport. Doesn't really have blockchain, DLTs specifically mentioned, but I mean, I think for all of us that is the same as saying blockchain, right? So I think that there's the next 1 or 2 years, things are really going to change, but it's a long haul. There's a lot of education that need to be done, both for the broader public, but as well for regulators.
Awesome. That's awesome. I'd like to after the conference, we definitely need to hook up, because I want to compare notes.
Yeah, for sure. We'd love to. That goes for everyone here.
Okay.
Which
My next question is
take next. Yeah.
yeah. My next question is for Tanya. And Tanya, the question is, how can an organization ensure a digital wallet transaction is properly recorded, authorized, classified as an expense, and supported by third-party evidence?
Sure. Thank you. So an organization can prove that a digital wallet transaction is accurate, authorized, and audit ready if it treats the transaction, and this is the important part, as a part of a controlled end-to-end expense lifecycle, not just a payment event. Most people think it's just a payment event, and that's not accurate. The proof comes, we've set up in the system 4 very specific pillars, if you will. The first one is a deterministic transaction capture, source of truth. The transaction has to be captured directly from the wallet or blockchain layer, not manually entered. We use the wallet native event data, so that would be on-chain, right, or the ledger logs. Then from there, we timestamp the data. It creates that immutable hash I was talking about. We have API ingestion into our expense system, and that's in real time. So this ensures completeness, that the transaction can't be altered or admitted, which is very important when we're talking about the finance stuff. Oh, trying to remember these off the top of my head. The second one is pre-authorization and our policy engine. So before any transaction can occur, it must be governed, right? A lot of people miss the governable piece of it. So that wallet that we have in our system now would be tied to an identity, like I was talking about the AI agent. So that could be an employee, department, smart contract role. Then we have spending policies that are embedded. So that captures things like limits, vendors, different categories. And then we have pre-approvement rails. So whatever customer we're working with who has the digital wallets, if they're whitelisted addresses or merchants they don't want in, we set that up on the front. So the number one question is kind of like, was this transaction allowed before it happened? That seems to be what everyone's trying to solve for. And we can do that up front, which is very important. Also, we have the back end piece, the proof of provenance or the chain of custody records on the back end, which leads into the third part of the platform, which is the cryptographic audit trail and classification mechanism. So this is where every transaction would carry a chain of evidence. So for an example, a wallet would link to user identity, then the expense policy, and then our accounting category in our system. From there, we would do the smart tagging or the notarization, and that's based on rule-based classification at the time of execution, which is important to point out. And then we hash that metadata, which would be, you know, the digital wallet, the AI agents, the invoice, the receipt, the counterparty data, any compliance or regulatory documents that are associated with it. I work a lot with different regulatory enterprises. So that'd be healthcare, gas and oil. So you have HIPAA there. You have the FERC and NERC and the pH MSA regulations that have to be accounted for. And then the fourth would be the third-party evidence preservation piece in our platform. This is the hardest problem institutions face, in my opinion, because it's not the payment, like I said before, but it's the evidence piece, the proof. Right? And this is really what I'm pushing forward for the education piece in the enterprise, right? I'm trying to make it so Web 2 data, anything from Salesforce to ServiceNow, an ERP system, a TIM system, that they understand I can make that enterprise grade in a Web 3 platform, because we need that to move forward, like many of you guys have said. So in this third-party evidence preservation part of our platform, what we're solving for, right, is to attach the digital wallets, the AI agents, the invoices, the receipts, the contracts, again, at the moment of the transaction. And then we store them in an immutable hash reference storage, IPFS, or a secure archive. This creates the chain of custody recordship. And then we anchor that proof on chain. So again, the Web 2 stuff can still remain off chain. We're just putting metadata on chain. So this gets around PII concerns, GDPR concerns. We've already calculated that and have that set up in the system. And so now you can prove things like basic things like when the transaction actually happened, who authorized it, was it authorized, does it match supporting documentation throughout the platform, has any of that documentation been altered whatsoever? And if we find out at the beginning when someone else comes into the system and tries to execute on an event that it doesn't match a digital fingerprint that's in the system and cataloged in our chain of custody record, then that transaction can't go through. So it has cybersecurity built in the front as well. So I hope that answered the question, Anthony.
Yeah, that surely did. I think we live in parallel universes, because exactly what you were discussing, I was going through the past 7 years of my life here in Japan. That's exactly. We were point by point when you were talking. I was like, check, 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 because that's what we've been going through. And hopefully, this year we're gonna finally, come out of the woods here and be able to showcase what we've been developing. But that was very, very informative, especially for people that are logging on and watching, to see how extensive your company is looking at the transaction process. Is not just a matter of point and click. There's a whole process behind it to validate.
Yes, there's that entire traceability infrastructure that is missing in so many other folks' their platforms. So I appreciate that. We've worked hard to get it to where it is.
Yeah, we definitely have to compare notes again, because some of the things I want to see exactly what you guys are doing and what we're doing, and see if there are any synergies there. Because once we finish launching here in Japan, our next goal, me being an American living in Tokyo, right. I've been here for 32 years. We're going to launch back at home.
Okay.
The proof of concept is going to be here, though.
What I'm hearing also, Anthony, from all of our panelists, is the complexity of what is ConsumerFi, and the fact that it's not just like on a supermarket shelf pulling the product off. There's actually this infrastructure that's behind that has to be accounted. So I think you have the question for our next panelist. That's a natural kind of fit in there.
Yeah. That's my next question is for Justin. And Justin, I wanted to ask, what is the most misunderstood aspect of digital asset taxes for the average consumer?
Yeah, honestly, pretty much everything. Everything about how crypto is taxed is misunderstood. The first thing is that in the US, at least, crypto is taxed as property, it's not classified as currency. So even things like buying a cup of coffee with some Bitcoin is a taxable event. As of today, no de minimis threshold exists. So even if I buy a $1 bag of chips at a vending machine and I'm using crypto for that, I'm triggering a taxable event that now actually needs to be reported. One of the other big areas that's misunderstood is like, I only have to pay tax when I cash out for fiat, right? If I put fiat in, I trade a bunch of cryptos back and forth, that's not taxable. It's only when I pull out the cash. And that's just unfortunately not the case. So working previously in the service space, that was the biggest thing that a lot of our clients would come to us kind of confused about, is they're like, hey, my traditional CPA was unsure of how this is taxed. I told them it was just when I pull it out for cash, and they're like, I'm not so sure about that. And that's when we had to have a lot of tough conversations around, yes, every swap, every meme coin trade is a taxable event. No matter how ridiculous the meme coin is, if you swap it for Solana, something else, back and forth, that's a taxable event. And then as we get more complex, and with the 1099 TAs rolling out, anyone that's traded on a centralized exchange here in the US has likely received one at this point. There's a lot of holes in that form. For instance, in 2025, cost basis for the most part is not reported to the user. It's definitely not reported to the IRS. But any assets transferred into an exchange, that exchange is not going to know the cost basis naturally. It's not a fault of their own. And so these forms, for most Americans, we're used to taking those 1099s, plugging them into TurboTax or handing them to a tax preparer, and then that's all you need. But these days, you're doing that. We're seeing users do that, and the CPA gets it, and they're like, hey, you sold a Bitcoin, but the cost basis section says unknown. Is this a 100% capital gain, or what is this? And that's really where the whole, crypto tax aggregator need really, shows itself, is you need something that's sitting in the middle to recognize I sent this from a cold storage wallet, and this Bitcoin was purchased 10 years ago, and the cost basis needs to be transferred over to Coinbase so that we can actually populate that cost basis when it's sold. So right now there's a lot of confusion going on. Something you said, Anthony, that really stuck out to me was having to more or less educate a little bit on regulators on kind of how this is actually working in practice. One of the big issues that I foresee, and it's still going to be it's still kind of an unanswered question, and we'll see what happens when we get there. But right now, the IRS wants to treat the 1099 DA as a source of truth, and naturally so. But the question is, users or taxpayers are not required to furnish cost basis and acquisition data to the exchange when they're transferring assets in. So if I have a Bitcoin sitting on my cold storage that I purchased in 2013 and I send that to Coinbase, I don't actually have to tell Coinbase the cost basis or acquisition date for that Bitcoin. And so as a result, if I'm using first in, first out as my accounting method, Coinbase actually might pull the wrong tax lot when they're preparing my 1099 DA. And so we need to determine what is the proper thing that user should report. Should they report the tax lot that Coinbase pulled, or should they report the tax lot that we know is correct based on the FIFO ordering and their entire picture? So there is, candidly, anyone that's been in the US or in the US crypto tax scene knows that this has been a very bumpy tax season. Hopefully we're going to get some more guidance. Luckily, literally yesterday, we got a little bit more guidance, the extension of the relief for using your own books and records to furnish your cost basis. So thankfully, we're moving in the right direction, but I think there's still a lot to uncover and make more clear in the crypto tax space.
Well, fortunately for us, the last administration didn't go through with their unrealized, taxes on unrealized gains, because a lot of people made a lot of money in Bitcoin in America, over the past 5 years, and imagine the impact that would have made. And this is the thing that was holding back here in Japan as well, is there wasn't any clarity as to where to go with the taxes. Japan's tax on crypto was over 50%. And now the new, so a lot of people were trading, but they were never exiting, they were never off-ramping into fiat, because they knew that if they did that, there would be a taxable event. So now, it's going to be cut in half and hovering around 22%. There's still talk about it this year. And I really believe that when that happens, you're going to see, instead of capital flight going out like in America, that's why a lot of these crypto bros were trading outside with other exchanges, using VPNs and whatever means they can to trade outside and earn, so they don't have to expose themselves to the U.S. tax base. The same thing here in Japan. We think that once the taxes, there's a framework in place, then people can know and they can take the necessary risks when they do invest in crypto. And that's one of the choke points, aside from all the other things. That's a major choke point, I think, for big whales that want to come into this space, because they don't know how am I going to get taxed.
Yeah, absolutely. I think there's definitely a middle ground. The crypto space will benefit with more clear guidance, but also reasonable guidance. We can't look at crypto through the TradFi lens, because it does not fit in the same, it's like a square peg into a round hole. It doesn't work that way. And so more clear guidance is going to be helpful, but at the same time, it needs to be reasonable. And then if we have the processes in place, if we have the guidance to point to, hopefully it will allow for more people to enter crypto safely, feel like they're not blocked by this big looming tax season that's going to be a complete nightmare to work through. And then hopefully we can get more people on chain.
So I want to thank everyone who's here. Sorry, Anthony. I am also going to invite everyone who's here, because this is really like an appetizer. We've only touched the surface of the tip of the triangle. So I know that with everyone who's here, we're going to do a fuller, longer talk show. I mean, David, when you were talking about, the give back to the community, and Tanya, you were talking about the complexity of the infrastructure, and Jacob, what you're talking about in terms of just the history within the Nordic blockchain, and also, from the Sum side, there's so much more that we can kind of chat about. And really, these summits are just to show the trends and the need for further discussion. So I want to thank everyone who's here. And Anthony, I know we're going to be talking at the end after our EndNote, which is actually, we have a EndNote speaker from the Ethereum Foundation. So that's going to be phenomenal. So I definitely want to invite everyone to stay on, because when you listen to Kyle and to see what's going on from that perspective, it's amazing. So everyone, we're going to bounce you out so we can have our next panel in. Thank you so much.
Thank you so much.
Thank you. Let's touch base. Thank you.
Everyone, fascinating discussion.
Good job. back.
We are back. We are back. And
Unless I'm mistaken, this is the final panel before the
this is panel 5, and it's amazing always whenever we do our global summits how fast 5 hours actually kind of happens. So we have another diverse panel, and we have Gerard, who is the founder and executive director of the Government Blockchain Association on, as we have others hopping in. So Gerard, I'm going to let you ask everyone for a short intro of their backgrounds while we have others hop on, and then we're going to start with the questions.
All right, sounds good. Well, I'll start myself. My name is, as Jackie said, Gerard Deshay, Executive Director of the Government Blockchain Association. I'm also the co-lead of the United Nations Internet Governance Forum Dynamic Coalition on Blockchain Assurance and Standardization. And a good friend of Jackie's. We've been together for quite a number of years, and we got a great panel with us. So let's start with Ashok. Do you want to go ahead and just introduce yourself, give a brief background, followed by Katsuya and Richard.
Sure. Thanks, Gerard, and thanks, Jackie. I'm Ashok Pinto, Executive Vice President for Legal and Government Affairs at the Blockchain Association. I joined the BA just in October after serving at the Department of Commerce in the International Trade Administration, and delighted to be here. Thanks for organizing this summit. I think you couldn't have asked for a more pivotal moment. So. And my prior service includes in the House, in the Senate for the now Majority Leader Thune, in the White House, and in the Treasury Department. So I'm delighted to be here, and I'm looking forward to this great discussion. Thank you.
Awesome. Ashok?
Hey. Hi, everyone. Thank you, Gerald. I'm Katsuya Terai from the Financial Services Agency of Japan. My department, the department I'm working at is the Crypto Assets, Blockchain, and Innovation Office of JFSA. So our primary role is to supervise the crypto asset exchange, stablecoin issuers, and also other related projects regarding the digital assets more broadly. Yeah, and also I'm working on the policy matters, so like the how to update our Japan's crypto asset regulatory framework, and also other dialogues with crypto asset exchange providers. So I'm very glad to join this panel, and also I'm looking forward to exchanging our views on crypto assets.
Thank you so much. Richard, you want to introduce yourself, followed by Albert, and then David.
Certainly. Hey, Jackie. Hey, Matt. Glad to see everybody on again. I'm Richard Jackson. Currently serve as the Director of Intergovernmental Affairs for the Digital Asset Regulatory Authority. In another life, also the Deputy Attorney General for Digital Assets in the state of Oklahoma, and a former blockchain technology co-founder for venture-backed startup. So I've seen the industry from all sides, and I think to reflect the points made by the panelists, I look forward to kind of discussing what we have to talk about today.
Awesome. Thank you. And then Albert, I don't see Albert here.
Yeah, I think that Albert hasn't had a chance to come in. He's actually in Australia, so we'll have David talk.
David.
Hey, Gerard. Great chatting with you. So my background, I just recently retired as a federal agent from the criminal investigation side of IRS, working with cybercrimes headquarters. Prior to that, working with policy and technology on the civil side from headquarters offices. Actually developed the first clustering algorithms in 2010 when we started looking at digital assets on the civil side. IRS didn't stand up a group until 2012. So that was the beginning of developing the John Doe summons that went to Coinbase in 2016, and the next year in litigation, and a lot of private banking with DOJ expert data analytics and things of that nature. Prior to that, military, retired from that to go to the civil side of the House and the federal government. And like I say, now retired, opening up and starting a technology company. I really phrase it more as a design, research and design company rather than a research and development, because a lot of the development companies are missing the design portion of what needs to be incorporated and included in the technology, with really a forward-looking eye on quantum resistant and artificial intelligence technologies around the inclusion within the technology space.
Awesome. David, I know you and I have talked for years. And one of the things I'm excited about doing is touching base with you about the blockchain maturity model, because design is such an important part of that. But let's move on to the questions, right? Ashok, let's start with you. You joined the Blockchain Association recently, and I'm sure it's kind of like drinking from a fire hose right now with so many things happening, which just happened with the announcement from the SEC. What are you keeping your eyes on? What are the things that we've got to sort of watch legislatively as we look forward into 2026 here in the U.S. and around the world?
Yeah, and that's a great point, because literally in the last, well, literally, yeah, in the last month, basically I've been very engaged with solicitations coming out of especially the defense side, looking at building with one of my PhDs in financial economics. Macro and microeconomists look at things very differently. As a financial economist, you look at currencies, currency systems. You're not looking necessarily at the macro and micro of how supply chain moves and things like that. And that's where, unfortunately, a lot of people get it wrong. And the aspects that they're looking for is a new model around geopolitical warfare and trying to develop new economic models, rather than continuing to use the old ones from the post-World War II era. And so that's been pretty fascinating to begin to look at that. And then shortly after that, kind of begin to see from, insights from friends I still have contacts with in military special operations, things like that. What developed into the current warfare model has developed into a cyber warfare aspect with Stryker. Medical technologies just recently being hit with a wipe attack. I've just been flooded with TV interviews that these are some of the big issues. Hey, if they're not going to go after government infrastructure, why are they attacking civilians? And so when you take a look at all of that combined, we have quantum resistant issues within current technology. We have issues of artificial intelligence being an issue, even with the Defense Department in this current conflict. They've kicked Anthropic out as a concern. And a lot of it has to do with it's kind of interesting to listen to people. Yeah, I know AI. Well, as an AI engineer, let's talk about this. And it's like, oh, no, you don't understand. I know how to use ChatGPT. I know how to use Claude. That's how I know AI. And it's like, okay, you really don't know anything about the models that you're using, because we've got issues around people not understanding their data is being mined. Every time they use it, their data is being mined.
David, let me pause you just for a second, because this is a great topic, and I want to come back to this in a minute. But let me switch over to more of the regulatory legislative landscape, right? Ashok, I know that from the Blockchain Association that you guys are looking at that. But let me give you an opportunity to weigh in on that, and then the rest of you guys.
Thanks a lot, Gerard. And I just wanted to say it's an honor to be alongside Katsuya, Richard, and David, and super grateful to the Blockchain Legal Institute for organizing this seminar. As I said, you couldn't have picked a more pivotal moment for the summit. And so I just wanted to say something briefly about who we are. We're the leading membership organization, and that's dedicated to a pro-innovation policy environment for the digital asset industry. And so we've got over 100 members, kind of all over the industry, software developers, infrastructure providers, investors, others who are supporting the public blockchain ecosystem. And we work with those members very closely. Our goal is simple: regulatory clarity and educating the policymakers and the regulators and the courts even about the promise of blockchain technology, how it's going to make us more secure, more competitive, and create a more digital friendly marketplace. And, just to put a point on it, what we're really looking at here right now at this moment is market structure legislation in the US, the Clarity Act of 2026. Just to give you to give everyone kind of an overview and sort of the state of play, um, the the current legislation divides digital asset regulation cleanly between the SEC and the CFTC. And this is kind of a big shift because really we're ending the sort of overlapping jurisdictions and the regulation by enforcement approach. And you're seeing this really, the two new inbound chairmen have really been very adamant on this point. We're not going to do regulation by enforcement anymore. We're going to coordinate very closely. You see that they've put out a memorandum of understanding, which to some seems obvious, but has never been done before. And so this is a really unprecedented moment. So the goal, another big thing that the legislation does is to categorize digital assets and create clear regulatory paths. We're divided in two Senate committees that are considering this: the Senate Banking Committee, which covers the SEC portion, and the Senate Agriculture Committee, which covers the CFTC portion. So if we look at the banking part of this, some key items are in Title I, providing this definitional clarity that's so important, codifying basic terms such as ancillary assets, investment contract, self-certification, and outlining pathway for primary sales and exempt offerings of digital assets. This covers like early stage projects, selling and offering tokens without constituting securities transactions. And this part also establishes requirements for regulated companies. And I think you've seen too some activity in the SEC around this just yesterday, the day before actually. Another key point: Title III covers illicit finance prevention measures. So that's the Bank Security Act, sanctions and risk management imposed on various actors in the digital asset ecosystem. We know from our discussions with policymakers that that's a very important thing to them, to really make sure that those prevention measures are in place. Another key point, very important to our members, is Title VI, which is developer protections, that ensures that non-custodial, non-controlled software is not improperly classified as securities intermediaries. And as part of that is the Blockchain Regulatory Certainty Act, BRCA, which is in Section 604. And so there too, not to make sure that these developers have protection and are not classified as money transmitting businesses. We believe that's super important for fostering innovation here in the United States. So briefly on the agriculture side, you've got portions of the bill which include the Digital Commodities Intermediaries Act that grants the CFTC jurisdiction over digital commodities, outlines requirements for CFTC registered entities, and then also, key definitions there are digital commodity exchanges, digital commodity dealers. So that's kind of an overview of the substance. Wanted to say a quick bit about where we stand. So the House passed its version last July 2025. And since then, the Senate's been working on its version, which of course is substantially different. And the ag portion was passed out of committee just late January, so just about 8 weeks ago. And the banking committee, there's a long anticipated markup, which we hope will happen this spring. We anticipate to happen this spring. And once the banking committee marks up its portion, the Senate will use its own Rule 14 to combine these two products, the agriculture and the banking component, and ultimately get it onto the Senate floor and for it to make its way to the president's desk for signature. So ultimately, at the BA, we believe that the Clarity Act is needed because it's regulatory certainty. We're encouraging domestic innovation, and really, it's in furtherance of the current administration has been really clear. They want to make the United States the crypto capital of the world, and make sure that these innovations are happening in the United States. And so, that we're hoping to see this signed into law this year. So I think that's where we stand.
Awesome. Hey, Ashok, let me ask you just a couple follow-up questions, and I want anybody else to feel free to jump in. I know there's a lot of content out there. It's hard to consume it all. I can't consume it all. So if you don't know the answer to this question, it's totally fine. But the problem that we had before was anybody who touched a digital asset then had to worry about the SEC coming and slapping them down, right? I mean, whether you're a software developer, no matter what you did. But one of the holes that we've had, and I don't know if we continue to have it, is the old pump and dump, right? Meaning, because the SEC is responsible to protect investors, right? Yet you had people generate these tokens, do a bunch of hype, a bunch of people buy it, then they do a rug pull, all these people lose their money. Where are we in that space? And a lot of times those things essentially were not illegal, right? So where are we for those kinds of protections? Are folks on the Hill looking at that at all? Is it still a hole? Are they trying to close it? Do you have any ideas about that?
Yeah, absolutely. I mean, as I mentioned, that Title III in the banking portion of the bill is what covers illicit finance. I mean, certainly we've heard those concerns, and policymakers have continued to express them. There certainly are.
Would you call those illicit finances? Those things aren't illegal now, as far as I know, right? Somebody creating a token, hyping it up, getting a bunch of people to buy it, and then essentially pulling the rug out. I don't know if that's illicit.
Yeah, no. If I could jump in.
Go ahead, David.
Sure. This has been an initiative of mine for some time, and recently partnering up with Jackie and Matt, and I raised this in my book that was just released in January. But when you take a look at the distributed ledger environment, it requires specialized oversight. And so what I've articulated in the book and share here is that it really needs an SRO, a self-regulatory organization made up of non-conflicted, i.e. no conflict of interest individuals with expertise in various technologies as well as trading areas, because that is where I have written both when I was in headquarters as a federal agent, and most recently as CEO of a technology company, to requests from the Senate Banking Committee to Tim Scott and his team about the need for an SRO, because they had a lot of great questions, but at the end of the day, they're not going to solve them through legislation. And so when you take a look at disclosures, there are significant disclosures that need to be made by L2, L3 platforms. They are not just these decentralized platforms that are autonomously operating. It kind of reminds me of the ServiceNow commercial where they tout their AI as autonomous minions that you control. Well, what does that mean? Autonomous, and yet they're controlled. This is the hype terminology that gets caught up in the technology area. And so an SRO would solve a lot of these problems. I know exactly what you're saying. At the Global Fraud Conference, I presented, when you take a look at Pump.Fund, or you take a look at a lot of these other L2, L3 projects that exist on the Solana and the Ethereum side that generate massive revenue for the
founders.
I can't say that they're decentralized, because they're truly not, because they've got foundations, they got corporations that oversee them. They're decentralization means command and control.
David, let me, super important. We're at 30 minutes after the hour, and so I'm trying to be mindful.
But anyway, the SRO would be a huge step in that direction.
So just real quick, then, is there essentially a gap? Is there a regulatory gap that the SRO potentially could fill? Is that what I'm hearing?
Well, that's essentially what Congress did with the what used to be NASD, now FINRA, in the securities area. And this would serve the same type of purpose. But it is going to take an initiative from within the legislative body to make this happen.
Yeah. Let me throw one thing out, then I want to go and talk about the sentiment in Japan and the rest of the world as far as financial institutions. But I want to put in the blockchain maturity model token supplement is a standard that if people implemented and used it would essentially, I think, stop a lot of these kind of rug pulls. We had somebody come to us, asked us to endorse something that they were doing, and we asked them if they would be willing to comply with the standards. And the minute they looked at it, because they had ill intentions, they said, no, I'm sorry, we can't do this. So for those of you that don't know about the BNM token supplement, I'd encourage you to look it up. Kitsue, I hope I'm pronouncing your name correctly. I'm really interested to find out a little bit about the sentiment in Japan with respect to financial institutions. As we look back, so many people have heard of FTX and Sam Bankman-Fried, Terra Luna, Celsius, right? And there's all of this fear, but Japan has been leading in the digital asset space. What is the sentiment of financial institutions in Japan as it relates to digital assets, and then in terms of what you know, maybe the rest of the world?
Okay, thanks for asking this question. I think I would say in terms of the sentiment or from the financial institutions or other institutional investors, I think my personal opinion is like their conversation has obviously shifted from just a debate as to whether the institutions are allowed to deal with crypto assets. What I mean by that is before in 2025 or 2024, of course I'm in a good position of talking to institutions because I'm their regulator. Then they were coming to our agency and they kept asking lots of questions about their legitimacy of dealing with crypto assets. But before they were still asking whether crypto should be treated as a very serious asset class. But I think post 2025, the discussion clearly shifted much more practical, and also, like, for example, what kind of exposure is appropriate, or what type of vehicle they should use in order to hold crypto assets, and as their portfolio management, and also what type of governance, what governance and should be applied, and also with what custody should be used, or what tax treatment should be applied to their investment in crypto assets. So
you bring up a really important point, and I'd like to maybe get your point on three aspects of it, right? So we've got crypto in terms of custodying for customers, right? We've got crypto in terms of investment, and crypto in terms of internal operations, right? Do you see a big difference in the financial institution's sentiment towards those three aspects of digital assets?
I think at this moment in Japan, under the Japan regulatory framework, especially banks are not allowed to deal with crypto assets. Of course, insurance companies are not allowed to deal with crypto assets. But in 2027, next year, we have new registration, new regulation in place. And I think in that case, banks are allowed to deal with crypto assets under their appropriate framework. And also, in terms of the providing crypto asset services like custody services to customers, I think banks are very they are in a good position of providing these services because banks have very strict internal control framework, which is very suitable for hold customers crypto assets in custody. Yeah, this is very good perspective, and also from the regulatory perspective. Yeah.
Yeah, I know that a lot of them. I know that here in the United States, especially credit unions, right? They're experimenting with custodying their own crypto, right? Before there's regulatory framework in terms of custodying customer crypto, right? Because it's an entirely different regulatory framework. But would you say that overall the mood in Japan is optimistic, pessimistic? What do you think?
Okay, so I'm not, regulator, so I cannot say, I will not overstate it by saying that, Japan has suddenly become very, aggressively risk on. Yeah, but I would say, obviously, their, tone is, changing a lot from last year, obviously, because, we have our agency have a new commissioner. Yeah, those she's very how to say in favor of the how to promote crypto assets and also other digital asset technology into traditional financial services. Yeah, this is key, perspective to innovate our financial services in Japan.
All right, excellent. Thank you so much, Richard. You've been out of the crosshairs for a little bit of time. You're now in the hot seat. So listen, as we're looking at this intersection of the world of DeFi and TradFi, right? What do you see? What do you see as the big sort of regulatory challenges and frontiers that regulators need, because these are two very, very different worlds, and they're going to have to interoperate. Right, and they play by very different rules, different cultures, right, different paradigms. How do you see those two things coming together from a regulatory standpoint?
Yeah, so I think when we talk about the regulatory frontier, it's talking about where we're going is as much a discussion of where we've been, and so regulation tends to be a lagging cycle behind market cycles. The kind of major, I'll call them kind of broad first market cycle for most people, 2014, 15, 16, 17, was followed by a regulatory frontier where the industry was effectively seeking to avoid regulation. If you recall, that was the IRS was making its kind of first initiatives into taxing cryptocurrency gains. And so the industry's reaction was, we're fleeing the old world, we're trying to avoid regulation as much as possible. We learned in 2021 and 22 and then 23 the second and third order effects of being unregulated, which was, I think, is what Ashok spoke to, which was it was regulation by enforcement, because there were no rules, there were no rules. And so I think the industry and it's the frontier in that post-market cycle regulatory kind of frontier was that trade-off between a willingness to consent to oversight and regulation in exchange for this kind of permissive authorization. The industry doesn't need permission in the sense that the blockchain is, of course, still decentralized and unregulated in as much as the market participants seek to have it be. But in terms of here in meat space, that human beings are subject to regulation as much as anyone else. And so there was a bit of a tension in a trade, the industry consenting to regulation in exchange for kind of the permissive authorizations. And so we're seeing these kind of major tectonic elements, market structure, the Clarity Act, the Genius Act, kind of the first forays. And that's this, I'd say, regulatory cycle. So now let's speak to the frontier as TradFi and DeFi kind of meet. What happens in this brackish estuary of the digital and traditional is, I think, where you're going to get the regulatory growing pains are down into the rulemaking and enforcement, law enforcement, particularly elements of what do we do now? This is new technology. It's making its way. I mean, I think it was announced yesterday that the NASDAQ has authorized tokenized trading in their systems. And so what happens when the crypto dog has finally caught the car that is these big, again, kind of continental discovery regulatory things, and we're down now into wading through the thickets. Speaking on behalf of the attorneys general around the country here in the United States, is that the technology is less than well understood and certainly not regulated very well, and how law enforcement interacts with this new technology that we barely have federal guidance on, let alone much state guidance outside, of course, perhaps California and the New York financial regulations. But what do we do in the other 48 states? And so if you talk about really the opportunity, I think what David was mentioning for SROs is, what do we do, now that the continent has been discovered, what rivers do we navigate up into the deep internals of what is, the extending the analogy, affecting the manifest destiny of the industry as it sort of overtakes traditional finance. So that's what I would, in summary, is really going to be that move from the big market structures to the atomic enforcements. What do attorney generals do? What do law enforcement personnel do? What do our downstream banking and financial regulators at the state and multi-state level do? That's really where the frontier of regulation between traditional finance and decentralized finance really lives.
You sparked a thought that made me think that Jackie may regret ever inviting me to be a moderator again, because I do tend to throw people under the bus and throw things to them. David, we covered some of the stuff that I think was part of the question already. So I want to kind of sidebar and still try to get you enough time to go into the details in terms of AI and quantum. But Richard, with respect to what you just said, when Satoshi Nakamoto created Bitcoin, right, there was this concept of decentralization, right? And then we saw DAOs and the whole concept. But as we look at Bitcoin and we look at the concentration of hashing power within a few mining pools, and we look at all of these other, the whole thing about the Genius Act is we want these decentralized technologies controlled in the United States, right? From a regulatory perspective, right? Is decentralization dead, or does the regulatory perspective take its hands off of decentralization, right? How do regulators that are all focused on controlled and holding people accountable, how do we deal with this concept of decentralization, if at all? And so that, I'll start it with Richard, but I want to open it up to anybody on the panel, because that's a mind bender.
So I think the way that I would frame my response to that is to consider the blockchain or decentralized information sharing in the same way sort of as the military thinks in domains, is that blockchain is a subcategory of the cyber domain, this kind of logical nexus between compute, the actual conversion of electricity to data, and then also kind of the logical concepts. And so I would say, while we're paying attention to what's happening in the Clarity Act, the Genius Act, the legislature, I would also, in a roundabout way, suggest paying attention to the way that militaries are thinking about compute as a strategic resource. And so when you ask the question, how do we handle this tension between decentralized capability while also wanting to control it? I think that question will be answered where it can't be denied, which is in the physical compute space. So your control over your data centers, control over your power, control over the network technologies. While Bitcoin and any other blockchain may assert its ability to remain decentralized, if we start trying to break global great power competition, starts flexing its muscles, I think you'll start to see regulatory capture, military or state control and capture, and the industry is going to unfortunately be confronted with another choice when the time comes. Is how does the industry, how do governments, how do market participants in effect answer that question in flight and in process, where the tension remains between authority, permissibility, and capability.
All right, David, I'm going to have you go last, because I'm going to segue your answer into more of the technology. Let me just give Ashok, Ketsu, you guys want to weigh in on that, and then I'll turn it over to David, and he can wrap it up for us. All right, David, you want to take a stab at it? Yeah, good. Go ahead and take a stab at it, and then let's talk a little bit about how do we keep all this stuff resilient with the advent of AI and quantum.
Sure. So I think to understand and to kind of springboard off of where Richard left off is to understand where technology is going. We have to understand where it came from. And as such, the concept of decentralization actually started with the French Revolution, and that's where the term was actually coined. And when you take a look at decentralization, it can't be coded into a network. As a matter of fact, when network technology started under Leslie Lamport in the 70s, networks were permissioned. Why? Because they're not secure if they're not. And so the concept of decentralization is actually never ever used in the Bitcoin white paper. Although the concept was raised out of that, it isn't in the white paper. And what everybody calls blockchain technology today is actually what, since the 50s, is sequential linear data hashing. It's just that Satoshi didn't put it in the white paper. So guess what? Media contrived a term. They took block and chain, which are used independently in the white paper, and created a technology out of it. And it's never existed as a technology. So with that framing, if we don't understand this technology, we don't know how to say, well, how does quantum cryptanalysis apply to this? Cryptanalysis being the reversing of cryptology. And how does artificial intelligence weave into this concept of distributed ledger data networks? Because the infrastructure, as an architect in DLT, there's many structures that create these networks. There's the node network, there's a messaging network, there's the data ledger network, there's a digital signature algorithm, there's the UTXO or account base. You get the idea. There are a number of complex systems that when I was sitting in the forums, when Satoshi was talking to a lot of the developers, and I had nothing to do with the development side, I was a researcher at that point. From a military perspective, I was sitting in the Persian Gulf during the first war, which led to multiple that I sat in, but it was in 90 that was so pivotal for me because I'd been reading David Chaum's work for years, from the 80s through his doctoral dissertation, who laid out the whole concept of a distributed ledger digital currency framework, that we didn't have an internet yet until 90. And everything that is in the Bitcoin network white paper, David Chaum laid out in his doctoral dissertation in 1979. So again, all of these things have been around forever. So I take that to quantum currency. Why are the existing infrastructures? We're putting a lot of time into developing policies, procedures, a legal framework around technologies that I've watched things go from virtual currency environment, gaming environments in the late 70s to the first cryptographically transacted assets in 1990 when we got the internet with David Chaum's work, to Bitcoin that I was writing to Treasury about in 2005. And it's just funny money. We don't need to mess with it. They're always behind the curve. So the point being here is that the first quantum money paper, legitimate academic white paper, was released in 2010. And it was introduced in that forum where Satoshi was talking to, and there are actually multiple Satoshis. There is the response to the quantum money paper, which is about 30 pages long, was, that was the response. We now have 6 quantum money papers that have evolved as quantum has evolved. Our next move is to quantum currency, and it's just as synthetic fiat. In financial economics, what everybody else calls stablecoin, we call synthetic. So we have synthetic equities, we have synthetic debt, we have synthetic currencies, and within that context, in cyber crimes, we called it counterfeit until the Genius Act was passed, because whether it's counterfeited in physical form or counterfeited in digital form, it doesn't make any difference. It was counterfeit. So now we call it synthetic. Anyway, quantum money as synthetic fiat has posed a problem for these quote unquote currency system. Bitcoin was supposed to be a currency system. Well, in financial economics, we know that a currency system, when you hoard the currency, people in economics, it says people will look for alternatives.
Yep.
And that's exactly what they've done. And
David, we
anyway,
hit the top of the hour. So wrap it up for me. I want to give everybody a chance to
the wrap up is the technology's changing. It's changing rapidly. Within the next 5 years, we will see the first iteration of quantum computing. It's already been converged with AI in a significant way. Look for everything that you're working on now to change over the next 5 years.
Thank you so much, David. Ashok, let me take it back to you. Final thoughts.
Thanks, Gerard. It's been a great discussion. Really appreciate it, and very much value Katsuya, Richard, and David's contribution. I'll just say that, really the important thing at this moment, as we look at it, is regulatory clarity. Better than the status quo, to have these guidelines in place to guide this industry for the next decade. So I think that's the important thing here, and that's what we're at the Blockchain Association, what we're really focused on. So thank you.
Thank you. All right, Katsuya.
Yeah, thank you. Yeah, it's been a great discussion and conversation. So I appreciate your commitment to this panel, and also I'm very looking forward to keeping in touch with panelists, because as an agency in Japan, and we're very much eager to catch up with what's happening in at the global level, and also what perspective should be prioritized in terms of the so that we are on the same page from the regulatory perspective and or coherence. That's why I'm so glad to join the this type of conversation. Thank you so much.
Super glad to have you, Richard. Final thoughts.
Thanks for moderating, and of course, Jackie and Matt, thanks for hosting and putting all this on. Not to be too Rumsfeldian about it, but I think we're now moving from the era of the unknown unknowns to the known unknowns, which means we're still in a realm and a world of unknowns. Kind of what David's mentioned is right, is that everything's going to be different in 5 years. So enjoy the clarity that you think you have today, because it will in short order be something that we are probably laughing about as being rather antiquated, as AI, quantum, and blockchain and digital assets kind of converge and interact and engage. So I will leave it. My final thought is being, I hope we can capitalize on what we have, and we'll see each other again on the other side of the next market cycle.
Hey, Gerard, I'm going to jump in here with some final thoughts, and then we're going to actually turn the table on you and ask you for a quick comment. So this has been a really interesting panel. From my side here, I've got Ashok on the left, and I've got Dr. David on the right, and sort of from Ashok's position, you've got, sort of the things that exist within the regulatory area, which are sort of supposed to be known, right? They're the things that we can sort of identify and we can deal with, and we can tag and manage, and then we know that so much more is coming. Being a producer of this series with Jackie over the years, things like NFTs maybe weren't spoken about during this summit, which is great, or it just shows it shows progress, it shows movement. Years ago, maybe stablecoins were, they were sort of the newer piece of conversation. Now, maybe this time, for the first time, agentic commerce has been discussed, and now quantum, concerns are definitely coming our way, no matter if we want it or not, right? So it's been a pleasure to kind of see the full spectrum. I think this panel sort of represented that to some extent, and I'm definitely looking forward to the next one. And then Gerard, why don't you tell us your thoughts on what we heard today, and then let's let Jackie wrap it up.
Thank you, Matthew. So something that I think about a lot is paradigm, right? And, you know, a lot of times there's shiny new objects that come, but really they're essentially just repackaged old things, right? So NFTs came along and some people said, well, these are just like baseball cards, right? And so a lot of this stuff, I don't really kind of get too excited about, you know, some of these things that appear new. But when it comes to the concept of paradigm, right? And Richard, when you were saying something, it reminded me of a conversation I had with somebody one time. They said, you mean to tell me that we don't have the answers? I said, no, what I mean to tell you is we don't even know what the questions are, right? And the paradigm that I've seen in my short time here in this industry is the very concept of sovereignty, right? So right now we live in a world where nations essentially are sovereign over their money, right? And as we see the fractionalizing of money, right? You know, so it's not just everything's going to be denominated in dollars, but you might have these tokens that represent, you know, gold that's still in the ground, or assets that, you know, revenues that haven't been realized, or all kinds of different things. And as I watch what happened with Russia and Ukraine and the sanctions, and then Russia that said prior, if you have Bitcoin or a digital asset, we'll send you to a labor camp. To now everybody's essentially trying to do business in stable coins, right? Because they had no access to the financial system. What I'm wondering is, and so now we have these stable coins, and the banks are asking, well, what happens if people put their deposits in stable coins and stake them, as opposed to put them in the banking system that is the basis of our money supply, right? You put your deposits into a bank, they don't hold it. They take that, they lend that to somebody else, the deposits in their bank, and they take that money and deposit in another bank. They use that to lend it. And so if we all essentially start moving our money into stable coins, the entire banking system is stressed, right? And so what would it be like to live in a world where our very concept of how, and one more thing with respect to regulation, right? We're used to this idea of we elect people, we appoint people, they go off to some place, they make a bunch of rules, they come back and tell us what the rules are, right? The ISO is like that, legislators. But with Bitcoin, a bunch of people just started doing stuff, and they came up with norms and standards, and they created this regulatory authority without any sort of central control. It was evolutionary, right? And so what I'm wondering, what I'm asking myself is, how do these paradigm shifts, right? What are these paradigm shifts? And while we're focusing on the shiny objects that are today, are we really thinking about, gosh, there's a whole new way of looking at things, right? It's like kind of discovering that the world is round for the first time, right? And we have to be open-minded to think that the very way that we think about this now might need an adjustment change. The way our war fighters, our war planners are looking how Ukraine, essentially a small country, is kicking the butt of this major global power, right? Wiping out their navy when they don't have any ships, because they took their top military guy, right? And so their minister of defense, they replaced him with the minister of digital transformation. So they said, this is not a military issue, this is a technology issue, and totally transformed how we fight wars globally. And so we need people that can look at the world and say, you know what, I've been looking through these glasses for the longest time. Maybe I need to think about a new pair of glasses to look at how we face these challenges. So those were my thoughts as I had a chance to listen to all of you very, very smart people. Jackie?
Yeah, so I appreciate everyone who's on this panel, because, you know, it's a whole spectrum of what and who you represent, and tying into both what, you know, Richard and David has mentioned in terms of the idea of an SRO. We have created DARA, a Digital Asset Regulatory Authority, which is a grassroots SRO. It's a general assembly of our community coming together. And it's like what you talked about, Gerard, it's having a different lens on how do we regulate, how do we provide guidance. And so that's going to be a whole nother conversation. Right now, what I'm going to invite everyone who's on is to stay on and to listen to our EndNote, which is, you know, we talk about Bitcoin
And then we have our end node as being from the Ethereum Foundation, because they are a huge part of our ecosystem, and they've created a lot of what we've been talking about in different ways. So we're going to be listening to Kyle during our end node, and then we're going to be coming back, bringing back Lonnie and Anthony to kind of do a wrap up for our global summit. And I also want to just remind you 2 other upcoming events. October, we're having our next global summit about real world assets. And then in July, we have a 5-day blockchain bootcamp, which is integrating blockchain and AI and everything that we've talked about here. And a lot of who you've seen on these global summits will be in person doing workshops and talking about the trends that will happen. As everyone has said, between now and July, who knows what we're going to see. So everyone, stay tuned for the end note and come back so you can hear about the wrap up as well. Thank you so much for being on, guys.
Thanks.
Thank you, Jackie. Thanks, everybody.
Thanks.
Really excited to have Kyle here because he is representing the Ethereum Foundation, and they've been leaders in this space. So Kyle, welcome, and thank you so much for doing our end note for our global summit on TradFi, ConsumerFi, and DeFi. How are you doing today?
Absolutely. Thanks for having me. Life is good. I'm having fun. It's Friday for me, and I'm just enjoying the ride.
Yeah. So why don't you share a little bit about your story? How did you come to be part of the Ethereum Foundation? And then we're going to be talking a little bit more about the guidance that the foundation provides to the ecosystem.
Sure. Yeah, born and raised Southern California. I went to the military at a very young age, at 17 years old, and ended up serving for 12 years. Had a lot of fun there. First working on fighter jets, and then going into the intelligence world. I was an Iranian linguist, an intelligence analyst. After that, I got my MBA here at Rice in Houston, and then I went to Goldman Sachs for almost 7 years. And while at Goldman, a year in or so, I became very heavy into crypto. So I started personally in crypto around 2016. And during COVID, I was able to work from home, but I spent most of my time in Mindshare in the crypto space, even while working full time. Goldman almost became my side gig mentally. And so my wife saw that I was unhappy at Goldman, where people were just kind of measuring wallets, and it was always kind of dog eat dog world. And so I finally got the kitchen pass to quit, took a huge pay cut, and to come work in the space and find some fulfillment. And I'm so glad I did. I'm so much more fulfilled. I'm so much more proud to tell my son what I do, why I do it, to be in this space, even if I gave up a lot of money and prestige at Goldman. So I came into the space, and for the past half decade before the EF, I've been leading protocols. I led something called the Graph for a few years, which is an indexing protocol that helps organize blockchain information and flow into a front end, all these applications we see. Then I spent another 2 years at an even nerdier protocol called Veil. And for the past few months, I've been leading institutional efforts for the Ethereum Foundation across North and South America, which it's actually a relatively new effort. The Ethereum Foundation, since its beginning, has always been very idealistic and cypherpunk, and not really doing much outwardly to try to get, especially institutions, to adopt. But right now is an interesting time because, as I've learned and as I've been dreaming about for a decade, institutions are not only paying attention, they're actively scoping things out. They're creating proofs of concept and pilots. Many are actually even in production with financial primitives, and now it's time for expansion. And so it's really cool to see that when I talk to institutions, and it's literally the biggest financial institutions in the world, the Goldmans, JP Morgans, the Morgan Stanleys on the bank side, the asset managers like BlackRock, Fidelity, and then the fintechs, Visa, MasterCard, PayPal's. When I talk to them, it's not, do you know what a blockchain is? Do you know what Ethereum is? It's more, all right, how are you thinking about the strategy? And they've probably already been thinking about it for years. And I get to work on their team, help them as a thought partner, and introduce the Ethereum ecosystem across layer 1s, layer 2s, and every application across the entire ecosystem. So it's actually a really cool role.
DeFi Summit. And, I've been in the space over 10 years, and it's happening so fast.
Biggest thing that comes up, especially with financial institutions, is privacy. They want to know, how do you have privacy in a public blockchain? And they just don't know what's happening across the space to enable that. A lot of, again, financial institutions worry about KYC, AML, how they have a single sign-on process, how they, if they're building their own blockchain, which multiple institutions are. One public company's Robinhood chain building on the Arbitrum stack. Like how do you interoperate between different chains if there are siloed assets? And so it becomes one large ecosystem. I often talk about post-quantum and where we are and match up roadmaps because they're thinking about the same things. Many are interested in agentic finance, so AI agent finance, and how that's already becoming a very realistic way for agents to interact, not only with humans, but amongst themselves, because an agent can't apply for a bank account. They can't have a physical wallet. And so crypto rails across the Ethereum ecosystem or others is just it's going to be the best way for agents to be able to access and interact across financial rails. And what's really important about the Ethereum ecosystem is it's just incredibly neutral. So it can't block someone simply, or any agent simply because of who they are or what they're doing. And so it's a very censorship resistant open source project, not even a project. It's obviously an established blockchain. So I'd say those are some of the biggest ones, as well as how do they, if they're doing something like BlackRock's Biddle Fund, how do they interact with decentralized finance? Because you can concentrate on the supply side, just putting things out there, tokenizing things, but how do you concentrate on the buy side, the demand side? And so decentralized finance, or DeFi, can really increase the utility of something as opposed to just putting it on chain and giving access to the world. You can use a lot of DeFi rails to do some really interesting things you can't even do in the traditional markets. I'd say that's the high level stuff. I get pretty nerdy with folks because I'm talking to heads of product, heads of digital assets, heads of engineering, CTOs. And then when I go up to the C level above that, like CEOs or anything like that, they often don't want to get in the weeds. They just say, how's this going to do something for my business? And so a lot of my role is just translating my ideals and why I'm here. But I don't say decentralization. I say resilience. I don't say these crypto buzzwords. I translate it so that it's real practical outcomes and functions. Which is what institutions actually want. They don't buy ideals. They don't buy philosophy. They buy outcomes. And so it's been a long time coming. And our team is small, and we're all kind of exec level from before. But I lead the Americas. There's a Europe lead, Mina lead, an APAC, and a global. And it's really fun. Yeah, and it's something that's important because in most of these conversations, even just today, I was on with the bank, and it's the first time I'd spoken with him, and he said, "This has been missing in Ethereum, where people are brilliant, but sometimes they just can't talk to institutions." Ethereum ecosystem from layer 1s, layer 2s protocols, all building this together across the world, async most of the time. So it's just an amazing global effort that's enabling something that can truly go 0 to 1 to upgrade existing financial rails. Yeah, the Ethereum Foundation just came out with a roadmap. Vitalik was the first to post about it, I think, and it's most importantly increasing throughput and scalability of the layer 1. Even more than that, increasing the scalability of layer 2s, which are these customized execution environments, and then the data from those get posted to the layer 1, which is the source of truth. So if something happens on a layer 2 that's malicious or wrong, just something goes wrong, you can still revert back via the layer 1 as a source of truth. And so it's that scalability. It's privacy, inherent privacy with ZK being zero knowledge proofs, being built into the ecosystem. It's it's all the stuff I talked to institutions about. So post-quantum is a big thing. Hopefully by 2030, I bet it'll be earlier. And I'd say those are the biggest things. Yeah, I'd check out the Ethereum roadmap. And then I think the focus of the foundation, where I'm very externally focused, talking to institutions, and they have to build iteratively as opposed to become completely idealistic like the foundation. The foundation concentrating on protocol is going to focus on what they call crops, which is censorship resistance, open source, private, and secure. That's the North Star for the Ethereum Foundation. Whereas I'm on the eco development team, the ecosystem development team. We are going to have to walk things through there, through institutions through there, others through there, to get to that. But we need to start a bit more practically. For the foundation, they want to stay idealistic, which is great. Well, eventually, everything they're doing right now anyway in the financial world is going to be on likely Ethereum. And it could be multi-chain. I think it would likely be multi-chain because some other ecosystems might have some different use cases. But I think from what I'm hearing from institutions, it's always Ethereum and maybe something else. It's never, all right, let's go somewhere else and ignore Ethereum entirely. So I would say even if you don't want to get involved in the ecosystem on your own, while there's still things that need to be ironed out on the user experience, because it can be a little janky right now, getting a wallet and bridging from one blockchain to the other and understanding what these assets are, understanding what decentralized finance is and how to avoid the pitfalls. And there are pitfalls, at least right now. In the end, I think most finance is going to be on blockchain rails anyway, so it's going to be a Trojan horse, and people are going to eventually be on it anyway. And then if you really want to meet the space and hear what people are building, I'd suggest going to an Ethereum conference. You meet the actual builders, ETHCC and Cannes. I mean, not everyone could go to Cannes, but if you're in France, there's one in France every year. There's DevCon or DevConnect that travels all around the world. It's been in Thailand, Argentina, Colombia, India, other places, Turkey. And so I'd find, and then there's ETH Denver, there's stuff in the States as well. There's Consensus Miami in May. There's a ton of very good conferences if you want to go meet people from the inside out. But if not, there's so much. It's just such an exciting time that institutions, BlackRock's going to tokenize 12 trillion of assets. And that's one institution. People will follow BlackRock. So I highly recommend just learning about this ecosystem and learn why we're doing it. So read the Ethereum Foundation's recent manifesto that we put out. Actually, you could just, and just understanding the values of the ecosystem and then relate it to how much better it is for the world. It's just not only gives people access with stable coins as opposed to a deflationary currency in a third world country. You can have access just with a connection to the internet to a stable coin, a US dollar coin, and not have access to a severely deflationary currency. And then you can not have that taken away if there's a dictator or something like that. That alone is going to really help a lot of people around the world. But then it just goes beyond that, the unbanked and so on. So it's just a really fun space to be in. It's a really fulfilling space to be in. And I feel very grateful. I feel lucky that I get to work in it.
And you know what, we're lucky to have you as our end node and also to have you in our community. So thank you so much for everything that you're doing. Everyone, we are going to go back to our summit right now. Stay tuned.
All right. You're on mute, Jackie. We've made it, everybody.
Yes, I was muted. We have made it. We started with our keynote, talking about a digital asset bank, looked at 5 different panels covering the entire type of ecosystem that is within our financial world, both the complexity as well as what we think is simple and understanding that it's not. Lonnie and Anthony, I know that you've navigated this in creating the various projects. What's your reflection on what we heard today and where you see we're going?
I realized by the way, all the panels were amazing. This summit was amazing. I learned a lot, and I saw a lot of different diverse ideas from everywhere around the world, and it really fascinated me to hear people finally talking about, we're not going to talk about blockchain, we're going to talk about resilience. It's not going to be decentralized, it's going to be resilience, like Mr. Rojas said at the end note. I think that's the direction that, I've been preaching that for 10 years. And now finally the world is understanding that, blockchain is just the engine, but it's in the front end, it's in the marketing side, and the understanding to average people is where it's going to matter. All these other things are going to have to, it's almost by default. Yes, you got to have consensus. Yes, you got to have all the checkpoints with the blockchain, that blockchain provides. That's a given. How are we going to disseminate this information to the average person has always been my mantra. And I was so happy to see that a lot of people are singing the same song. It was really nice to see. And aside from that, we've been talking about stable coins, Jackie and Matt, as you know, for many years now. And now we are seeing the advent of the stable coin now rushing in. But then again, there was when on panel 3, I think it was, when Hiroshi was on there and some others were talking about, the stable coin is just a centralized, it's centralized control with the banks. So we're still not, out of the woods yet, but the fact that we're on here talking and sharing ideas, that's the best way for us to make an impact. And I'm really happy to be a part of it.
Yeah, there was a lot talked about today, a lot of great points, from institutions entering to regulation, maturity, and infrastructure evolving. There's so much progress that's happening in the space. In fact, this is our 3rd global summit with you. Mm-hmm. And, it's the evolution from the first one to the second one. And then now it seems like there's so much more progress, but yet there's still a lot of confusion and uncertainty. So there's still a lot that needs to be worked on. And I think that still the main part of our mission has been to bring mass adoption, usability, ease of use, and to give people the tools, because that's in the end what we're all doing this for. It's for the people. And so that continues to be our mission, is people focus. And we're really excited because we're going to be rolling out a lot of different pieces this year. As you know, we don't have just one piece, but we have this full ecosystem, and not just with the wallets and the infrastructure, but we also bring in the community as well. And now we've got the manga, for the storytelling, and we're trying to piece all of these things together, and yeah.
I have to say, when I listen to all these people, I realize I'm not the smartest person in the room. They're so much more smarter than me, but the fact that I get to share my ideas with them, and, we only know what we know, and we only function in the environment that we're in. And, we hope to be a good example coming from Japan to the world that, there is a way, there is a pathway to mass adoption, and that's leading with the consumer first.
Matt, what are your thoughts?
Well, I just want to say, as usual, big thank you to the team from Rio. I know y'all are up late, and
thank you.
It's 6:30, Matt. It's breakfast time.
Oh well, we don't need breakfast, brother. It's like, so we've identified a conference in Tokyo that we want to go to. Hopefully, we'll be producing the next one with all of you from Tokyo. That would be lovely.
Wonderful.
I think some of the things that were, there's always a theme because we're all in the West, right? In a sense,
Mm-hmm.
Japan kind of represents the West as well, and Europe specifically as well. So I think maybe, looking forward to the next summit, themes around mass adoption in the global South, maybe themes around education and bringing all the tools that we all discuss and all the regulations that we all discuss, the innovation that we all discuss here, and kind of maybe putting it in that lens might be very interesting. It's something I think about. I think the quantum stuff is becoming very real. The agentic networks and the money, things that we call stable coins, maybe really transitioning into this space where agents are really pervasive. It also represents another attack vector, and it's like a contract. The more terms you add to the industry in general, the more terms you add to the contract, the more problems it might represent. And so the larger our industry gets, the larger the surface area gets, and it becomes we're all looking for put things in a box and to make them fair and to make it simple, right? This is some of our goals. But the more that we grow, inadvertently, the more complex it gets. So as always, I'm happy to be a part of, I'm sort of the wallflower in these shows, which is great. I just get to soak it all in. So that's my comments. Jackie, why don't you tell us what you think?
10 years ago, when I stepped into the space, I never thought about learning about pay rails or stable coins or, I bought, an altcoin and then Bitcoin on an exchange and then, learned about mining. So there's been so much that, like you said, that we all learn as we kind of navigate this technology. And then, Matt and Anthony and Lana, with our hosting the hackathon, learning about that. And then, so these global summits really are just really the tip of the iceberg. It's just to kind of have the conversation started. So as people are kind of trying to learn the vocabulary or what the thoughts are, they can kind of use this as a starting point. And I think maybe it was David or maybe it was Gerard that talked about, or maybe Richard, that we're living history. And where this is going in 5 years, we're going to look back at our summits and say, wow, that was then. Look where we are now.
Right. Exactly.
So these are, and that's true with any of the videos that we see on YouTube or whatever. We see the history of where we've come from. So it is going to be very interesting, but also like what David from, the Wyoming side spoke about, it's important to, and you both of you have talked about it too. It's important to look at how are we giving back to the community with any technology that we're creating. How do we return some of those profits to support both the education as well as other needs that our community has? So that's where I'm hoping we'll all be looking and see how can we make this a better place for everyone.
Yeah, I think we're just like in the dot-com boom. Remember in the mid '90s, and then it went to 2000, and everything was exploding. And I think we're in that stage right now with crypto, because it will rise up and it'll drop, and then you're going to have the legacy players rise up, from the ashes. And I think we're at that stage where we're seeing who are going to be the players. I mean, there were major tokens that launched, 10 years ago. They're no longer here. We thought that was the play, but they're gone. So, just like Google, I believe like Google was the 13th search engine. I believe, correct me if I'm wrong. I think it was the 13th search engine before, and now look at them. So I think we're at that age, and it's going to be interesting to see, after the shakeup, and the sifting happens, who's going to be the major players that's going to actually impact society and impact the world on a very basic level, like the internet did. And I'm so excited to be a part of that. Even though if I'm long in the tooth right now, I'm 62. I'm not a spring chicken anymore, but I hope that I bring the wisdom of being 62 to the game, and I learn a lot from these young players now. It's very satisfying to see them mature in this space very rapidly.
Well, I think that we will see a lot of what's going to happen over the next 6 months between our next global summit. And I know that all four of us could talk forever, but we are going to wrap up our summit. And we will come back with the talk shows that I promised everyone when they kept wanting to talk. We will definitely have 30-minute segments, so we will have more education. So we appreciate both of you. Matt, I'll let you have the last comment, and then we are going to end it.
Wow. All right. Well, it's been wonderful. And, again, big thanks to, the team at Rio for believing in the work that we're doing. And again, we believe in the work that y'all are doing, leading with the first principles and leading with inclusion, leading with fairness, all very much what we're all about. So looking forward to continuing this partnership in these amazing summits. I'm definitely looking forward to the next one, even though it's a long journey, even a longer journey for you all. Big thank you to the Rio team, and thanks to everyone that was a part of this. And at that, we'll sign off and see everyone again soon.
Thank you.
Thank you
guys
so much.
Thank you, everyone, so much. Bye for
Enjoy
now.
the next video.
We are going to be the first coin born in Japan going international.
We've been working so diligently to make this project the most groundbreaking project.
Rio will be at the forefront of this revolution.
Rio is a digital payment solution
used by the masses.